based off what I saw at the conference. This is the Bretton Woods for Bitcoin. This is day one of a centuries-long trend. Strive announcing that it is purchasing Semler Scientific. This really is the start of something much bigger. I won't name names, but this is something that was discussed at the Treasuries conference. I think you see the BlackRocks of the world look to acquire one of these companies. MicroStrategy essentially is V1 of a Bitcoin financial services company. You can't just be an ATM machine forever, right? The next logical step in my mind is real estate relative to Bitcoin, or Bitcoin relative to real estate, has grown 14x in just 6 years. What we're more interested in is siphoning that capital without having to have people sell their homes. I think Bitcoin has the potential to fundamentally change the way that structured real estate finance works. Bitcoin is fundamentally changed in the way that it behaves. You saw Galaxy facilitate the single largest sale of 80,000 Bitcoin, and the market didn't flinch. $100,000 is a huge psychological level. The longer you see Bitcoin spend at these levels, the stronger it becomes. September is generally a really poor month for Bitcoin, and it's followed by its two strongest months. October and November of this year, you're really going to see some pretty good stuff.
Archie.
Hey, welcome, Joe. How you doing, man?
Doing great, Archie. Thanks so much for having me on, man.
It's my pleasure. I was just saying off camera before was that I feel like I know you. We've never actually met, but we've had so many discussions online, and that I actually feel like you're one of the few people online that I've met, even though I was anon for the longest time. But so yeah, I'm really happy to be hosting this discussion with you. Thanks for joining us, man.
Yeah, absolutely. Thanks for having me on. The moment I got your DM, I said, let's do it. It feels like we met before. I've never seen you in person, but we've interacted so much, we may as well have, right? So
yeah. And I feel like I wish I was a version of my younger self was a closer version of you, like emulated some of the things that you're doing as well. Because we're just talking about entrepreneurialism, and my approach to things was just far too much stuck in my head and driven by ego to not make mistakes. Whereas you're just like, I've got an idea. Let's put it out there in the marketplace and see what comes of it, and learn from that experience rather than trying to plan everything so meticulously, which is, I think, one of the biggest mistakes I've made in my life was doing that. And but how did you come across that approach to starting your businesses? Because you've done a bunch of things that a lot of people don't know. Like, some people call them side hustles, but I'd say they've been more successful than that.
For sure. Yeah. So it really all started with the Bitcoin layer. The first break into this industry, the second company that I helped run / build. I'd say it goes as far back as once we were kicked out of school for COVID. I went to the University of Vermont. We were kicked out of school, and then I thought, okay, I can't go back. They're making me do all my courses online. What's the best use of my time? I'm in school to go into business. How about I start a business? What's the easiest thing that I could start doing with basically no experience whatsoever? Really high margin stuff. And so I did a general contracting company. I had no idea how to paint. I had no idea how to do woodworking or anything like that. But basically, once I got home, because they didn't let us come back to school, they wouldn't even let us come back into our dorm rooms to get an overnight bag because we were away for spring break when they kicked us out, I just called up a bunch of my friends and then hired them. And then I went door to door and asked if I could paint people's houses. And that ended up being a huge learning experience and kind of this first window into starting something when you don't necessarily know what you're doing. But as far as Bitcoin goes, and I did that, for basically 2 summers. After the first summer, I realized, like, okay, the way to build a business is to just start doing things. If you get too stuck in the ideation phase, you end up wasting a lot of time. Versus if you go out and start something, and then if it doesn't work, you'll know pretty soon, and so you can stop and move your resources elsewhere. Whereas if you start something and then it proves that it works, very, very early on, you can continue iterating and building on that versus the other way around where a lot of time is wasted. You can almost visualize, and I've seen this out there, kind of like an imperfect circle, right? Kind of like a scribble on a board. And then over time, that's what you start with. Over time, you can make it into a perfect circle versus spending weeks, if not even months, of ideating on this circle and trying to make it as perfect as you can before you launch it. Just launch it and then make it perfect later.
Looking for a secure, trusted way to buy, sell, and hold Bitcoin? Gemini has been leading the way since 2014. Founded by the Winklevoss twins to be a security-first, fully regulated Bitcoin platform. With Gemini, your Bitcoin is protected with enterprise-grade security, backed by insurance and Type 2 certifications for SOC 1 and SOC 2. Whether you're new to Bitcoin or a long-time hodler, Gemini gives you the tools to stack sats and build generational wealth your way. From simple one-tap buys to advanced charts and trading features, it's all here. Buy, sell, and hold securely. That's Gemini. Gemini. Bitcoin with confidence. Need cash without selling your Bitcoin? With DeBiFi, you borrow against your Bitcoin, non-custodial, multi-sig escrow, and you keep your keys. No banks, no selling, just institutional grade liquidity with terms up to 2 years and APRs as low as 9%. All transactions are signed using private keys on your own device. Using a 3 of 4 multi-sig setup, 3 out of 4 keys must approve every transaction, giving you control, transparency, and peace of mind. Whether you're a hodler, miner, small business, or treasury team, DeBiFi gives you the cash you need now without giving up your Bitcoin upside or triggering a taxable event. Get liquidity, keep exposure, and stay secure. That's DeBiFi. DeBiFi, your Bitcoin, your money.
And as I got more into Bitcoin, I realized that, like, okay, that's actually the founding ethos of some of the most successful companies in this space, and also some of the most successful companies in Silicon Valley. You look at early Facebook, that's essentially what they did. They started, they had no idea what they were doing or where this was going, but they got early traction and they just stuck with it. And so with the Bitcoin layer, exact same thing. We didn't necessarily know what we wanted it to be. And so we just got started. We got started with the Substack newsletter. We transitioned into doing YouTube. We transitioned into doing Zoom calls and monthly spaces and more frequent tweeting and scheduled spaces and all these different methods of growth and types of content delivery. That was further learning about that. And then, as far as Theya goes and Horizon goes, which is, my current 2 ventures, we basically do the exact same thing. Move fast and break things is one way of putting it. But really, I think the more pressing phrase and the more pertinent phrase for everyone to hear is that you can just do things. A lot of people will say that, and they don't really know what it means. You'll know what it means once you live it, right? You can really just do things. I have barely any credentials at all, I will say. The only credentials that I've had that are really worthwhile are the businesses that I've been able to build. A lot of what I learned in school, I don't use in practice on a day-to-day basis, right? I did not get a marketing degree. I did not get a degree in writing or a degree in content strategy. I got a degree in finance and economics, double major. Even what I learned with the economics degree, I do not use. At the school I was at, they don't teach Keynesian economics. They don't teach Austrian economics, rather, anywhere, except for Hillsdale College, Austin University or Austin College, I can't remember, and a couple of other places. But the dogma that I was taught with my economics degree, I don't use. And so even though I do a lot of commentary on the economy and what the Federal Reserve is doing, I come at it from a lens that I learned entirely separate from my schooling. So it really, like, what I've been able to do, I'll call it my life and work. My life and work, it's been less than 5 years in this space, has been just writing stuff that I find interesting and learning and failing in public. The other thing that I think you may mention was people may call it a side hustle, but for me, it was, a legitimate business. Was I ran a clothing company for a little while. And ultimately I decided to stop doing that, not because it failed, but because there were other opportunities. And I got a lot of learnings from that. That was a totally solo venture. I did it out of my garage. I from front to back, I learned so much about marketing. I learned how to create clothing designs. I learned how to commission people. I learned how to do all these different things, billing, invoicing, getting an LLC set up, all this stuff. And it really taught me, even more than I had already learned through my other ventures, to be scrappy, right? To be really scrappy and hungry and go after something. And that taught me a lot too. And so really it's all about, for young people that may be listening to this, for older people that may be listening to this. I won't claim to be, wise or have any type of sage advice people may not have heard before. But what I will say is that doing more things increases your likelihood of success, right? Rather than sitting there and betting on one thing, doing a higher number of things increases your likelihood of success. Just don't fear anything. The worst thing that can happen if you try something is failure. The worst thing that can happen if you don't try something is that you live with regret. And what I'll tell you is that regret is a much more desperate, a much more powerful feeling than failure. Failure is, if you can pick yourself up from failure and view everything that you don't succeed at as a learning experience, then that'll build your resiliency and your likelihood of success later on. So that's what I'll say as far as entrepreneurship goes. I have a very limited experience in it and what I've been able to do. But what I've found is that the more things you try, the better you'll be at the things that end up working out for you.
I would say that that's quite an extensive experience. Most people would not have started 4 businesses in their lifetime. So for you to have done that within the space of 5 years, I think is a testament to your courage and your work ethic as well. I wanted to go back to the start when you've got an idea. Mm-hmm. How do you validate that? Because one of the things is you said you can just do things. At what point do you do things, and what exactly are you doing to validate that idea as having enough merit to invest yourself further into it?
Yeah. So as far as companies that are online, right, entirely online, no dedicated office space, talking about the Bitcoin layer, talking about Theya, talking about Horizon, at least for the time being, is that a lot of it comes down to putting these things out on Twitter. With the Bitcoin layer, it was a research company. And so how did we validate that idea would work? We did the research, we put it out on Twitter, we published it, and based on our feedback, we saw whether or not it would work, but also based on your impressions, you'll see whether or not it works. Same exact thing goes for YouTube as well, right? When it comes to any form of media, you'll never know if something will work if you're going out and doing market research and saying, okay, this newsletter does this and this part works about it. You'll never really know. You're really just shooting in the dark. So, as far as media goes and content goes, publishing your ideas is how you gain validation. As far as things like Horizon goes, those require a lot more dedicated market research. With us, essentially, the idea was pretty simple. People came to us with Theya. Our Theya customers came to us and they said, hey, we want to be able to post our Bitcoin as collateral and get a Bitcoin-backed loan for it. Can we get financing on our Bitcoin? And being a self-custody company, Theya is a modular multi-sig product that allows people with any hardware wallets to basically throw together a multi-sig vault. We believe we're the simplest and most intuitive method of doing that in the market. But essentially, being a self-custody company, offering financing on your Bitcoin isn't the best thing in the world for us to be doing. It's totally antithetical to our ethos, rather. And so we said, okay, we're not going to offer that to our users, but what we can do is explore different methods that we can use to help people acquire more Bitcoin, right? And essentially, one of the during our market research phase for that, we discovered that home equity in the United States rose from $20 trillion in 2015 to $35 trillion in 2024, and that was a real eye opener because that's just money that's sitting there, and it's an increase in wealth that you're not gaining from, you're paying for through property tax reassessments, right? Prime example, my mother, her home in 2015 was probably $700,000. In 2025, it was, or 2024, it was 1.2 million. At least that's what Zillow said. And so that wasn't wealth that she gained. That was actually an unrealized gain that she ended up having to pay for through property tax reassessments. And so we started viewing home equity as this massive untapped pool of capital. And through the success of places like Strategy, companies like Strategy, who are essentially speculatively attacking out of the dollar and into Bitcoin, and targeting all of this institutional capital in the United States, we view home equity in the exact same way. And so we started exploring options for people to be able to essentially diversify out of one and into the other. And so there was a lot of market research that was involved in finding the exact vehicles to do this. But rather than trying to reinvent the wheel, essentially the way that we got Horizon up and running so quickly is we found a financing partner who could do this. Not Bitcoin native necessarily, but starting out essentially with a financing partner that could allow people to take a chunk of cash out of their home to purchase whatever they'd like. And essentially that's how we got this product to market so quickly. Rather than doing the alternative method of essentially building out a huge wait list and then waiting and then working for years and years and years to find financing partners who, for example, would allow you to post Bitcoin as collateral, right? That would take us years and years and years. Instead, what we decided to do was partner with an existing financing partner that would allow us to really get started basically on day one. And then after we got huge results, which over the last 4 months since we've been live, we've been, so humbled to have been able to receive huge results, over $1 billion of home interest, several $1 million worth of contracts extended. The only reason we were able to do that was because we went to market quickly with a solution that already existed. And now it's opening up the door for us to build entirely new models, right? Where Bitcoin can be held as collateral, where you can draw more out of your property to buy Bitcoin, because the financing partner and other banks, for example, are now seeing the success of our model. So, really it's these two diverging paths. The path that we took was the exact same path that I've been talking about this entire interview thus far, which is getting to market quickly and then perfecting it later versus the other way around, right? This is a solution. This is an idea whose time has come. And instead of basically sitting in that market research phase forever, we found an existing solution, brought it to market, and now we're working on honing that solution. And we start with an imperfect circle and we make it perfect over time. And it allows us to get from point A to point B faster. So validating an idea, it varies tremendously depending on what industry you're in, what product you're talking about. But that's how we've been able to do it, both on the content side for myself with the Bitcoin layer and Nick and the entire team over there, and also on the financial product side with Horizon.
Yeah, I mean, there is a concept called minimum viable product that people in Silicon Valley have worked as a framework to validate an idea, and that's something that I think I didn't pay enough attention to it when I was starting businesses at a younger age. I just felt like I think I just fell in love with ideas too much. I just wanted to perfect an idea, and there's no such thing as a perfected idea before you go to market. Like you said, you do it as you go to market, and your customers give you feedback. That's a really good summary, and it leads us into the company that you're working for right now. So you mentioned Theya and Horizon. Tell us a little bit about what Theya is, and then I guess as an example, how did you then sort of come across the idea of Horizon as a result of what you were doing with Theya as a self-custody model?
Of course. Yeah. So Theya was birthed out of the FTX collapse. Essentially what happened during FTX was trusting custodians. This was the central problem, trusting custodians with an inordinate amount of Bitcoin. And one of the products that they had was a yield generation product. The meme of the day in 2022 when all of this went down was, where does the yield come from? And essentially what we saw en masse was counterparty risk blowing up, right, in the Bitcoin space. Highly unregulated, basically entirely overseas shops. You had some that were stateside like BlockFi. But ultimately what you saw was what happens when you trust your Bitcoin with a counterparty and you don't know what's going on behind the scenes. And so really it kind of brought to light the need for a really, really simple Bitcoin custody solution. When you think of custody, in the traditional sense, most people have no idea what you're talking about. My stocks are in my Fidelity brokerage account, right? They're not going anywhere. I don't know what you mean by custodying this asset. Bitcoin is a bearer asset, meaning you can hold it, right? You can be the one that has sole access to it and nobody else. That's first of its kind as far as a digital asset is concerned. And so the solutions that existed at the time were either far too clunky or far too expensive, right? If you wanted white glove treatment, if you wanted somebody who could help you do this easily, chances are you would need to outsource it and it would be very expensive for you. If you wanted to do it entirely yourself and work around the cost of it, you would need to have a lot of technical expertise. And so that's a huge gap to be filled, bridging the world between security and affordability and ease of use. And so that's how Theya was envisioned. And so I wasn't on the team at the time, but essentially the team that was assembled in order to bring this product to light and actually, go through the initial funding stages had a tremendous amount of experience when it came to building these consumer products and working in Silicon Valley. Our Chief Technical Officer is formerly Robinhood, ex-Google, ex-GameStop. We have two gentlemen who worked at Deutsche Bank previously, a couple of gentlemen who have built and exited massive startups in their time. And so a lot of technical expertise in building these products and then figuring out what consumers like and they enjoy. And so, that idea was tremendously validated in two ways. We were the first, and as far as I'm aware, only Bitcoin native company to go through Y Combinator. So Y Combinator is the foremost startup accelerator in Silicon Valley in the United States. And we went through Y Combinator class of winter 2023, I believe, basically pitching this idea. The high level vision, the overarching vision over a long time horizon, pun intended, was to become a fully fledged like Bitcoin bank, right? Self-custody would be the first product that we built with that. But over time, more products would come into the fold that would allow people to actually either put this asset to work in a low risk, low price liquidation risk or no price liquidation risk way. or methods of acquiring more of this asset and really putting it to work. So essentially, over a long enough time horizon, becoming a full suite Bitcoin financial services company. Fast forward a little bit, Theya for consumers, big hit. It still is, right? People are still downloading it every single day, assembling multi-sig vaults, assembling joint Bitcoin accounts with themselves and their wife and their family members. And then, we built a product for advisors, financial advisors, wealth managers that allow them to help their clients manage their Bitcoin holdings. And then we built a product for businesses and really capitalized on the Bitcoin treasury company craze, but also for Main Street, right? So businesses being able to hold their Bitcoin in custody, holding one key, they're another person in their company holding a second, and either Theya or a third person in their company holding that third key. And all three of those businesses have been huge. Those products have been huge for Theya, particularly the second and third product. Those have allowed us to scale massively. And the next logical step was, okay, we've kind of built every product that there can be in self-custody in its current state. What can we do from here? What can we do to work on and expand upon that initial vision of becoming a full suite Bitcoin financial services company? And as I mentioned, our customers were coming to us and asking us for different methods of posting their Bitcoin as collateral to acquire financing against it. And in self-custody in its current form, and really, so the idea of self-custody is to basically hold that Bitcoin for the long term, not put it at risk at all. And acquiring yield on that Bitcoin or acquiring cash for that Bitcoin is kind of, in a way, antithetical to the idea of self-custody. And so we tabled that idea, but we did take that customer feedback and explore options of integrating Bitcoin with traditional finance, right? Integrating Bitcoin and potentially using it as collateral. And one of the things that we stumbled on is actually the inverse of that, right? Using other assets as collateral in order to acquire more Bitcoin in a low risk fashion, right? In a low or no price liquidation risk fashion. And we stumbled upon home equity sharing agreements. Home equity sharing agreements traditionally, in practice, what they allow you to do is you're a homeowner, you're sitting on a decent amount of equity. Let's say you're in your 30s, 40s, or 50s. You're going to be in your house for a while, but you want to do a home improvement project. Traditionally, the way that they've been used is to acquire cash for your home without new debt, without monthly payments, without interest charges, in order to, let's say, redo your floors, right? It's a very short-term thing. You pay it back, in relatively short order. And that's usually how these things have existed for a very long time. You don't foot the bill on monthly payments, but you can do these, projects around the house that you've been wanting to do for a while. We looked at them as a unique and novel method of acquiring cash in order to purchase Bitcoin, which is something that nobody had done before. There were a couple of different options in the market at the time that we began ideating on this that allowed for something similar. To acquire financing against your home in order to go and buy Bitcoin. Many of them were reverse mortgages or deferred interest loans. So they did carry interest. Some of them did carry monthly payments. But ours was fundamentally different because it didn't carry any of those things. And so, the light bulb really went off when we realized, this is not utilized for investment purposes to this point. Why is that? And also, Bitcoin is an asset that everyone believes in. Everybody wants to acquire more of it. The whole meme is, I'm going to sell my chairs and go buy some Bitcoin, right? But what if you didn't have to sell your chairs? What if you didn't have to sell anything in order to buy Bitcoin? What if you could take this mountain of equity that you've built up and what your home is worth now and leverage that and go acquire more Bitcoin in a low or no price liquidation risk fashion? And really, that's the window that was opened up with home equity sharing agreements. And so we worked essentially from last June or July, when this idea initially came to us, all the way until May, when we launched the first product. We announced it a little bit earlier, February or March of this year, and then we launched it in May. We worked really tirelessly to acquire funding partners, to get this thing to market, to build out a front end, to build out a back end process of getting these things done. And then we launched it. Currently, it's a Theya product. It might not be for very much longer, but essentially it exists within that stack, right? That kind of Bitcoin ownership and accumulation stack, financial services. The entire team that's behind Theya is also behind Horizon. On the one end, you can custody your Bitcoin holdings in a safe and secure manner that really doesn't take any technical ability to do, any major technical ability to do. And we're very proud of that. And then on the other end, for homeowners who want to acquire more Bitcoin, we've built a very novel and seamless and efficient way, a process that allows them to purchase more Bitcoin. And so that's how, the Theya idea initially came to the team. I was brought on board shortly after that V1 of the Theya product came to market. And since then, we've been building not only that stack out, but then the Horizon stack out. And now what you have is kind of a Bitcoin accumulation engine on one side and then a Bitcoin preservation machine on the other. And that's kind of the Theya and Horizon story to date.
So what's the target market of assets in the housing sort of pool that you're looking to address? And what is the incremental flows or potential incremental flows into Bitcoin as a result of this kind of product or products similar to it?
So I did a research piece. It's called The Great Repricing, and I released this back in August. I was kind of on a crunch to release it because I wanted to have it as fleshed out as possible, but I also wanted to get it live before I went off and got married and went on my honeymoon. Because this was just a pretty hectic summer that I've had. But I wound up publishing this in August, and essentially talking about the total target market. I went ahead and did all the math, and I quantified that the global real estate market in total is about $370 trillion. That number comes from Jesse Myers over at Smarter Web Company currently. At the time, I'm not sure he was, but he's kind of been famous for talking about Bitcoin in relation to other major global macro asset classes. And he calculated global real estate at about $370 trillion. In the United States, residential real estate is about $60 trillion. It's at an all-time high. Actually, I just published a couple of days ago. Actually, it's $55.2 trillion. That's the total value of the U.S. housing market. And within that, there's about $34.5 trillion worth of home equity. And so as far as the total addressable market for this specific product goes, it's $34.5 trillion. And so that's a major market. When you compare it to other asset classes out there, we'll go global. You take a look at things like equities, which are $135 trillion. Bonds are $318 trillion. Money in general is $129 trillion. Art and collectibles is $27 trillion. Gold is $23 trillion. Real estate is $370 trillion in size. And so this is the single biggest asset class in the world. And it's the single biggest asset class in the United States. If you just ignore all of the derivatives and you just look at the notional value of these things, real estate is the single largest asset class in the world and in the United States. And so I went ahead and calculated the intrinsic value of real estate. I calculated what the bricks and mortar and the value of the land is versus, and then I compared that to what the market value of it was. And I calculated that based on if you were to tear down a home and rebuild it today, what the replacement cost would be. And of that $55.1 trillion worth of U.S. residential real estate, about $33.3 trillion of it was actual bricks and mortar and land value. And the remainder of it, right, some, close to 30% of it, or actually over 30% of it, was pure monetary premium, right? This premium that existed on top of the actual brick and mortar and land value of these properties. And so that's the total addressable market. And then within that, there's this monetary premium that's baked in, which is essentially monetary capital has bought homes in order to use them as investments when they were never intended to be investments at all, right? All they should serve as is a utility. And this is further corroborated. This idea of homes shifting from a utility asset to a monetary asset is validated by some survey data that was recently published. If you go ahead and look at a survey that was published by Clever Offers, they've gone ahead and found that of the boomer generation, right, the generation that has the largest percentage of U.S. residential real estate wealth, if you exclude private equity, over 60% of them have said that their home is their greatest financial achievement. Right? Think about that. Their home, which is simply a place to live, is considered a financial achievement. Moreover, about 60% of the average American's retirement portfolio is in their house. And so ultimately, this has become a financial asset when it was never intended to be one. And another startling statistic is that nearly 3/4 of them plan on never selling their house, right? So essentially what you have here is housing has become a financial asset, whether people choose to believe it or not. That was exacerbated in 2008 when instead of allowing these banks to fail, the Fed came in and saved the banks and essentially ensured that's when homes became a politically protected asset, essentially an asset that the Fed makes sure the price of them never goes down. And as a result of that, home values, the total value of the U.S. real estate market has never been higher, and it will never be in a state of secular decline. The residential real estate market, the commercial real estate market is kind of folding now, but as far as the residential real estate market is concerned, it's a politically protected asset class that's never going to decline in value. And so when we think about the biggest opportunities for Bitcoin, you talk about incremental flows into Bitcoin. In my mind, the biggest opportunity for new Bitcoin buyers and incremental Bitcoin flows comes from U.S. home equity. It's this market that's huge, and it's only going to get huger. The Fed is now cutting interest rates. Obviously, the market has had a bit of a wobbly reaction to that, and we'll talk about that as well. But in my mind, because real estate's a politically protected asset class, as they've demonstrated 3 times now, right, in 2008, 2020, and 2022, they've demonstrated that at every single turn, when there's a threat to the housing market, they always come in and prop it up. Same thing goes for the S&P 500, frankly. Because it's a big market and it's only going to get bigger over time, really, that is, and it's larger than the equities market. It is the single biggest opportunity for new Bitcoin buyers. And so really what we want to do is build the tools for the capital to flow from one into the other. Talking about incremental flows, right? That would be, kind of back of the napkin math. But what I can say is that even if you assume, let's say 5% of the total value of U.S. residential real estate would move into Bitcoin, 5% would be basically the larger than the size right now of Bitcoin as an asset, right? $55.1 trillion, 5% of that is roughly around, $2.5 trillion ish. And that's bigger than Bitcoin is right now. It's like $2.34 trillion. It's 112, I think, behind me.
What about as a multiple of the amount of capital that's already moved into Bitcoin? Is that around about $1 trillion already?
Correct. Yeah. So real estate relative to Bitcoin, or Bitcoin relative to real estate, has grown 14x. So global real estate in 2019, Bitcoin was only 0.04% of that. Now in 2025, as of I think last 2 weeks ago when I calculated this, it's 0.6% of global real estate. So that's a 14-fold increase in just 6 years. So already some capital has flown from real estate into Bitcoin, from people directly divesting. But what we're more interested in is siphoning that capital without having to have people sell their homes, right? We think that is the single biggest opportunity for Bitcoin and for homeowners over the next several years and several decades, is essentially mobilizing their home equity, an asset that over the last year, national average is 1.65% in major metro areas. It's been more than that in terms of growth, less than 2% growth, into an asset that over the last year is up 99%. Right. That's the single biggest opportunity in our minds for homeowners, but also thinking about Bitcoin as an asset. If you take the total addressable market for residential real estate and you say, okay, what if 5% went into Bitcoin? What if 10% went into Bitcoin? What if these private equity firms sold their real estate holdings and decided to buy an asset that was doing much better? They decided to essentially transform physical capital into digital capital, right? Michael Saylor talks about this. That is a generational opportunity right there, not just for Bitcoin holders, but for homeowners to capitalize on that shift. It's a shift that's already underway. The conversation has shifted massively from where it was previously, these institutional inflows, to talking about real estate as an asset that people can outright sell or swap from one into the other. And we believe we're really leading that charge with this product.
Is there potential for real estate investment trusts to also, offer or engage in a similar kind of product where they're using their real estate portfolio to buy more Bitcoin as well? I mean, it doesn't really make sense if you're a real estate company to do that. I mean, you're involved in real estate, right? But if you look at it from an investment portfolio management perspective, where you're just trying to get the best possible return, it does make sense to do that. Do you think there's scope for that industry to come into Bitcoin?
I think so. I think as an investment manager, maybe working in a company that is offering real estate investment trusts, it may be prudent to maybe hold 2% of your capital in Bitcoin, maybe even 4 or 5% of your capital in Bitcoin, purely from the standpoint of protecting yourself, right? Right now, real estate investment trusts are offering between 5 and 7% in annual dividends to the holders of these REITs, paid out monthly or quarterly or semi-annually. And right now, existing homes are selling for a premium over new homes. Why is that? That's because these companies who are building homes at such overinflated values are having a lot of trouble selling these things. And so they're marking down their prices. Why are they marking down their prices? Because they have construction debt and they need to move on from one build to the next build. And they're willing to foot a smaller margin or even foot the bill on a loss than not sell these things, right? They have a lot of debt on one side of the equation. On the other side of the equation, they have homes that are not selling. And so they're forced to sell them at a smaller, for a lower price. And so I view Bitcoin from the homeowner's perspective as huge, but also for construction companies and investment managers who are managing these REITs as a pretty big opportunity. Because even though it isn't a cash flowing asset, it's an asset that you could use to protect yourself in times such as these when your homes are not selling. And it becomes increasingly difficult to either work within the confines of what your existing construction debt allows, or pay the dividends on your real estate investment trusts. And so I think for real estate, for REIT investors, Bitcoin offers a pretty unique opportunity. You're not getting paid dividends that you can then go and reinvest. But what you are getting is an asset that's appreciating by 100% a year for the last 2 years, if not more, and at the very least has done 25% over a multi-year time frame. The lowest Bitcoin's 4-year CAGR has ever been. If you take a look at its 4-year CAGR, it's 25%, right? That's the lowest that it's ever been. And so ultimately, for the people who are offering these trusts, it essentially offers an insurance policy in times like this. Instead of having to rely on banks to come and bail you out, or saying, hey, look, we can't do that, 5% dividend. We can do a 3% dividend or a 3.5% dividend. And that causes massive outflows from your trust. What you might be able to do is kind of offer a dual collateral structure where this instrument is collateralized 80% by real estate properties and 20% by Bitcoin. And then in doing so, you can offer a tremendously higher yield, right? Even with just a 20% Bitcoin component, your REIT can go from 5% to maybe even 11 or 12%. And also you're ensuring that in times of crisis, in times where your homes are not selling or they're not cash flowing as much as you'd like, particularly for commercial REITs, my goodness, the vacancies have never been higher in major US metro areas. You can insulate yourselves in times like that, prevent outflows, and make it so that on the margin, you have a REIT, you have a structured real estate financial product that's outperforming others. And it can really save a lot of these companies that are operating on really thin margins and potentially foreclosing from doing so if they just blend a little bit of Bitcoin into it. So I think that real estate backed Bitcoin financial products, or I'll say like a blend of the two, these dual collateral products will be a huge hit once they start coming to market, because it offers a better yield for the investor on the margin. And it also makes it so that even construction companies who have to sell their homes at a loss don't have to do that anymore. They can keep their homes exactly where they are and know that they have an asset on their balance sheet that's appreciating and doing quite well, so they can weather these storms that we're experiencing a little bit better. I think Bitcoin has the potential to fundamentally change the way that structured real estate finance works. And as far as real estate investment trusts go, I think that it's a no-brainer to do. We've already seen this validated in the market. Grant Cardone's Bitcoin and real estate hybrid trusts, building these multifamily places and these commercial properties. I believe it's mostly multifamily. It's been hugely successful, extremely successful. He was able to sell that thing very quickly. And so the integration of Bitcoin and real estate is an idea whose time has come, and the market has voted on that. And so now it's on financial institutions in the United States to create these products and satisfy the demand, both to the benefit of real estate companies, but also to the benefit of Bitcoin as an asset.
So I just wonder how that would work. Would that be on a project by project basis, or is this going to have to be a long dated fund that would at least ride out what we've seen Bitcoin cycles endure, so a minimum of 4 or 5 years? I know Saylor's, when he was raising debt, it was 5, 6, 7 years. So how would a real estate company manage the Bitcoin cycle in addition to what they're having to manage within the property market? Because property is also a cyclical business as well.
Extremely well said. These would have to be long dated instruments, right? You're looking at 10 years plus. You saw the initial success of Saylor's convertible notes. Those were 10-year notes, right? Those were 10-year instruments, essentially borrowing at literally 0%, oversubscribed, and then saying, hey, I'll pay you back with 0% money in 10 years. It's essentially a bet that, Bitcoin will do more than zero over 10 years. And so essentially real estate would need to operate in the exact same way. These hybrid Bitcoin and real estate vehicles, the initial version of them, I think, would need to be long dated, right? So you need to be locking people in for 10 years, either through a note or even something like a preferred stock, right? If a public company wanted to go ahead and test the waters on this thing. Not just to manage the Bitcoin cycles, but as you said, property is also a cyclical business. And then it becomes a question on the investor relations side. How do you market a vehicle where people need to lock up their capital for 10 years, right? And the thing that I would say about that is that sovereign debt right now, I have the Bloomberg terminal pulled up. If you lock your money up for 10 years with the US government, you're getting 4.12%. The value prop for this type of vehicle, let's say an 80% real estate, 20% Bitcoin vehicle, would be that, okay, with even a high yield corporate debt or middle of the road investment grade corporate debt, you can get 200 basis points on the 10-year US Treasury to 600 basis points on the 10-year US Treasury. Throwing in 20% Bitcoin and 80% real estate, that could bring you up to maybe even 15, 16, 18, 20%. And that can be something that's promised over 10 years, right? So that's how I would think it would need to be done, because you need to manage around real estate cyclicality and also Bitcoin cyclicality, creating long dated instruments that would allow you to weather the storm of Bitcoin cycles and also real estate cycles. And so really to this point, we've only seen closed end funds do this, like Gary Cardone's fund. I think the next player to try and experiment with something like this will bring this open to the public, right? Institutional investors at first. I think that's the next way that you do this. You create a 10-year structured note for institutional investors. You do a roadshow about it. You explain the product mechanics. You raise, let's say, $10 billion, $50 billion for this type of instrument, probably $10 billion to start. And then that really serves as the minimum viable product for this thing. Once the news gets out that is an extremely oversubscribed instrument, because you're catering to a much more risk-averse portion of the market, then more people try and do this thing, right? In the same way that when Sailor's convertible notes were oversubscribed at 0%, a lot of companies woke up and said, whoa, like this seems to be a really successful way of raising capital to strengthen our balance sheet with Bitcoin. I think in the same way, you probably see a player or two try out this type of, maybe 10-year, maybe 5-year convertible note that's backed by both Bitcoin and real estate, guaranteeing, 15 to 20% annual coupon rather, as far as convertible notes go. And then from there, should that be oversubscribed, that's telling you that the market has an appetite for this thing. And then more companies decide to do it.
Yeah, well, we're touching on Michael Saylor's strategy. So why don't we just dive headfirst into that? Because as someone who majored in finance and has left that industry in the past for myself, I mean, I never really worked deeply in it, but watching his company innovate in this space has been breathtaking, and the selfless way that he's been promoting all the other companies, ostensibly his competitors in the space, has been incredible to watch. And then we've just seen, I think Metaplanet this morning announced a Bitcoin buy-in, I think it was 600 million plus. Mm-hmm. So they're now hitting their stride where they're able to raise capital at the scale, almost at the scale. They're starting to scale up, to do similar things, to make similar moves to what Michael Saylor's strategy has done. I know that strategy is raised into billions, but to raise 600 million is not that far from $1 billion, to be honest. And it seems like their trajectory is heading well and truly into the same sort of level of capital raising. What have you made of the financial instruments that Michael's company strategy has innovated in the Bitcoin space? Have you had a chance to take a good look at those?
I have, yeah. I've done a lot of research. I've done a lot of videos and other content on it. They're extremely innovative, right? And it's very telling. He's created kind of different flavors of preferred stock, of these fixed income-esque instruments to serve different areas of the market.
Can we start chronologically to what he first launched? And then perhaps that might tell a story about the innovation curve and the adoption curve in the fixed income markets.
Yeah. So as far as the chronology goes, I can't recall what he first launched. I believe it was Strike, and then I believe it came all the way to Stretch. In the middle, I don't remember what came first, Stride or Strife, but I believe that's the rough order. So he began with Strike. Strike is essentially a convertible cumulative fixed preferred stock. I believe it was issued first at $8, $8 dividend per share, annually, paid quarterly, with a 10-to-1 convertibility for MicroStrategy shares at $1,000. Essentially, that's targeting two corners of the market. Number one being real estate, number two being bonds. Real estate as an investment class, obviously, it's very rent seeking, and it is cash flow seeking type investors, right? Strike as a preferred stock was able to hit on those quite a lot. And then also the general fixed income market, right? Global bonds are a $318 trillion market. And then he came to market with Strife and Stride. I can't remember the order in which he did that. But you have a perpetual cumulative fixed $10 per share dividend with Strife, and then a perpetual non-cumulative fixed $10 per share with Stride. Both of those targeting different areas of the bond market, right? People who are at different areas of the risk spectrum, and people who are at different duration appetites, right? People who want to be in these vehicles for a different length of time, and people who can stomach a different amount of interest rate risk. And the one that has been most successful, and essentially all of those are vehicles to pump capital. You can envision these sort of as pumps or even bridges from these different areas of the market into Bitcoin. And then finally and lastly, and their most successful launch to date has been Stretch, which is a perpetual cumulative variable 9% of par at a par of $100. And that gets paid out monthly, right? So currently, I don't know what the dividend is. I don't have the dashboard pulled up, but that vehicle paid monthly, right? At that point, you're targeting cash, right? Offering a variable dividend that was launched at 9%. If you look at money market funds, those are tied really closely to the front end of the U.S. Treasury curve. Right now, the front end of the U.S. Treasury curve, 1 month bills are doing 4%, 2-year notes are doing 3.5%. And so offering 9% on launch, that is a much better deal than these vehicles that are offering much less, and they're paying you on a lower cadence. And that was hugely successful, right? That was massively oversubscribed. They ended up, I believe, doubling the initial amount of this product that they were selling. And that targets money market funds, right? I mentioned there high yield savings accounts who are similarly, high yield savings account may be investing in corporate bonds. They may be investing in U.S. Treasuries. They're offering, anywhere from 3.5% to 4% annually. Stretch is offering double that. And ultimately, people can look at the mechanics of these vehicles and they may have skepticism, but the ultimate test is whether or not people buy it, and also time, right? These vehicles are very new. They're very nascent. Many of them, if not all of them, have been launched within the last 12 months or within the last 18 months. So we'll need to see over the next year, over the next 2 years, the next 5 years, the staying power of these instruments and the ability of strategy to pay these dividends down without needing to sell their Bitcoin, right? Currently, the MO is to pay these things down by creating new obligations, whether they're new preferred stock obligations or they're selling common stock that's not an obligation, or they're selling common stock, right? They haven't said that they will sell Bitcoin. We will have to see over the next 4 years, 5 years, whether or not these vehicles see continued success and they're able to maintain those dividends that they are promising, or whether or not strategy has to sell any of its Bitcoin in order to pay these dividends. I don't believe they'll need to, right? But ultimately, the market will determine these things in time. And really what has happened here is tremendous innovation at the crossroads of traditional finance in Bitcoin. The fact that these instruments exist and that they were so successful tells me that all of these corners of the market, right, whether you're short duration money, you're middle of the curve, you're long duration money, you want access to Bitcoin, you want yield, and you've been starved of it. And these vehicles being issued by an entity that has over 650,000 Bitcoin on its balance sheet have proven to be hugely successful in attracting those yield-starved investors over to the other side of the aisle, right? This Bitcoin side of the aisle. And that's why you've also seen more companies attempting to do something similar. Metaplanet has been hugely successful. Metaplanet is a very unique story because in the United States, there are a whole host of options that you can choose from in order to get yield. Our government bonds, right? You can park your money in the 30-year and get like 4.8%. You could park it in 1 month bills and get 4%, right? So there's no shortage of of products that offer yield in the United States, and our government bonds trading well above the reported rate of inflation are proof of that. In the West, it's not so much of an issue for us in the United States, at least. In Japan, it's an entirely different story. Their bond market is completely decimated. They've had negative yields in real terms for a very long time. They've imposed yield curve control for, I believe, the better part of a decade, pinning their rates as low as possible in order to encourage investment elsewhere. And it's fallen flat on its face. And so what Metaplanet is offering is this, essentially the sailor strategy over in Japan. With their new preferred stock instruments, they are aiming to create the best-in-class fixed income instruments that are offering yield to a cohort of investors over in Japan who've been completely yield starved. So that's why they have been hugely successful in the market that they're operating in. And I believe this is a trend that's going to continue proliferating, continue getting more and more popular. And ultimately, I think the next companies that will be hugely successful in doing this, running this playbook and doing this strategy, will be differentiating themselves from the standpoint of their operating business, right? So far, the market, as far as common stock goes and the way these things trade, has really loved selling common stock and buying Bitcoin and doing nothing else. We don't care what your underlying business is. We have no interest in it. We just want to know that you have a team of operators that can successfully do this trade and outperform Bitcoin, right? The two key indicators are obviously your MNAV, but more than that, your Bitcoin yield and whether or not you can actually outperform Bitcoin over a multi-year, multi-decade time horizon. And so I think the key differentiator for companies that are coming up in the space and starting to do this more will be whether or not their core business is low capex, high cash flow, and better than that, takes in Bitcoin revenue as well, right? So a hugely profitable business that has one underlying core business or several underlying core businesses that take in Bitcoin revenue. I believe that will be the next class, if you will, of Bitcoin treasury companies that succeed, because so far the ones that have succeeded have been the ones that have started this and been able to run this playbook effectively and successfully in different markets, right? In the United States, you have Strategy. I don't believe anybody is going to surpass them, right? They have 650,000 plus Bitcoin on their balance sheet. Metaplanet has Japan, if not all of Asia, right? They now hold, I think, 25,555 BTC as of this morning on their balance sheet. In so far, the geography has been the key differentiator for the success of Bitcoin treasury companies. Moving forward, I believe it's going to be that. I believe it's going to be kind of an underlying engine, if you will, of Bitcoin accretion, where it's not just your public vehicles that you're creating, but it's also an underlying business that you have that has direct Bitcoin cash flows, or at least a huge amount of cash flows, a high degree of scalability, and you're either putting those directly into your treasury or you're flipping cash that you're receiving into your treasury. I think that will be the next hugely successful player on the market. I know it's not a question you asked, but that's immediately where my mind goes to is what's next, right? Strategy has succeeded in this. They've come out with the way that they're going to actually honor these dividends and honor these obligations that they have. Metaplanet has done the same in a different geography. I think the next player that will succeed will be the one that has a core business that's highly profitable. And better yet, the kicker, the sweetener, if you will, has annual recurring revenue that comes in Bitcoin terms.
Why do you think that's so important as opposed to revenue in fiat?
Because ultimately what you're seeing is that Strategy essentially is V1 of a Bitcoin financial services company, like a Bitcoin bank, if you will. They have short and long-term debt obligations and a lot of Bitcoin on their balance sheet. And the reason that their debt obligations get so oversubscribed is because of the Bitcoin on the balance sheet and the yield that they can offer as a result. And so, the next logical step in my mind is if you are morphing into a bank, you need to have an underlying operating business that's profitable, right? You do not have the Federal Reserve of Bitcoin. You do not have an entity that can go and create Bitcoin. And so from an investor standpoint and a long-term success standpoint, you can't just be an ATM machine forever, right? You can't just sell common stock and then buy Bitcoin forever. You need to have an underlying business that's highly profitable, not only in order to weather the storms of the Bitcoin cycle, but also to weather investor fatigue, right? If there are a million MicroStrategy copycats in the United States, 99.95% of them will fail, right? What are your differentiators beyond your team of operators as a company? And for me, I think that it just makes the most sense that you have a cash flowing business that takes in dollar denominated revenue, but also that takes in Bitcoin denominated revenue. Because if what investors are seeking is outperformance that comes from Bitcoin, I think it stands to reason that companies that take in Bitcoin revenue would be uniquely positioned to attract those investors, right? And so that for me is why it's so important. And we talk about this parallel economy quite a lot. In reality, in practice, we haven't necessarily seen a parallel economy emerge. Bitcoin's monetization has actually taken more of the path of the Trojan horse, right? It really has infiltrated traditional finance and offered yield to yield-starved investors, and as a result, enabled more Bitcoin purchases. That's the way in which Bitcoin has captured traditional finance in a way. And really, we're still at day one of that process, but it hasn't really built a parallel economy so much as it has been a Trojan horse for the time being. And that's what has led to Bitcoin's success over the last couple of years. It's been a huge component of Bitcoin's success. Rather than individuals buying, companies that have created vehicles for institutions to gain access to Bitcoin, whether it's direct spot access through the ETFs or whether it is proxy access through these Bitcoin treasury companies who are issuing preferred stock in the United States and in Japan. And so for me, it makes the most sense that a company that can successfully kind of cross that bridge, if you will, to taking in Bitcoin revenue directly, and then down the line, once you have this fortress of Bitcoin in real time, being able to put that Bitcoin to work, being able to create actual financial instruments that may pay out in Bitcoin. For me, that is kind of where I see this all headed. And that's what can be enabled by Bitcoin denominated revenues. You can work around a lot of the tax implications of having to flip the dollars for Bitcoin or vice versa. That's why I see the market heading in this direction. You can't have an unprofitable core business and solely do the speculative attack forever, particularly if there are a million players in the United States that are doing it. I think the way that you succeed is by differentiating yourself and having long-term stability and an ability to repay these debt obligations that goes beyond just issuing more of your instrument. That's why I'm so convicted that will be the next play that does really well, particularly here in the United States.
There seems to be a race to accumulation right now before the search and establishment of a viable business model that can help monetize that stack. How long do you think that runs before we do find that some of these treasury companies, through experimentation, whether through financialization or otherwise, start happening upon viable business models?
I think that those can happen in tandem. What we saw very early on this year, Metaplanet kind of went out and announced, actually, I think it was in the summer, they went out and announced, and then I think, they retracted it, or they walked it back a little bit, or they corrected what they had initially said when they essentially said that, look, we would be exploring how to put the Bitcoin on our balance sheet to work, to make other strategic acquisitions in order to put create an underlying profitable core business or put our Bitcoin to work. The market didn't like it at the time. The market was hugely negative about it at the time. But I think Metaplanet's announcement was early, but it wasn't wrong necessarily at all. I think that's the direction that these companies need to go in. And I think that the market, more than anything, and this is the reason I'm saying this, is because these were ideas that I had before the New York conference, and these are ideas that were validated by the people at the Unconference. I spoke to a lot of the execs, a handful of the execs at these treasury firms, both stateside and elsewhere, about this idea that the next people that would be hugely successful, and even the current models that are out there in the general public that will continue to be successful, will be the ones that either make strategic acquisitions of other businesses to accrete Bitcoin through their, through general cash flow, or the ones that have not yet gone to market publicly but choose to do this from day one. Would be the ones that would succeed. That idea was validated by the folks over in New York. And to your question, I don't think it's so much as a timeline as I think it's, these things can be done in tandem, right? But nobody has yet to really try it, right? People have kind of dipped their toe in the water. Metaplanet, for example, about this, the market rejected it, and they kind of pulled that back. I think from day one, if you make it abundantly clear, like a new treasury company that's directly coming onto the scene, that we're going to run the playbook at the same time that we are going to use outside capital to scale our core business for long-term Bitcoin accretion. I think if you can effectively pitch that to investors and effectively craft your story around that, then I think the market doesn't punish you. I think the market to this point, what we've seen is they really don't like when you change, not change up your tune or make a wholesale change in the way that they're doing things. But I think it just boils down to investor communication. If somebody could come onto this scene and from day one say, hey, we're committed to doing both of these things. We're committed to running the capital markets playbook, creating financial instruments in order to accumulate Bitcoin for a balance sheet, and at the same time, utilizing our existing core business to flip cash flow into Bitcoin or acquiring other businesses that have Bitcoin cash flow. I think the market would really love that. But we've yet to see a player who can effectively pitch that to the market and have anything other than the market rejecting it. Yeah, I'm highly convicted in the way that this is heading. I won't name names, but this is something that was discussed at the Treasuries conference and was validated. So we'll have to see what people do over the next 12 to 18 months here.
You mentioned the Bitcoin Treasuries Unconference. Big shout out to Tim Kotzman. He's done a tremendous job of like making this his thing. You know, the whole Bitcoin Treasury thing sort of just crept up on everybody, and there was a kind of a bit of reluctance by, I guess, the existing Bitcoin community to embrace it because it's very much a corporate phenomenon or investment phenomenon, which is, I guess, a lot of people perceive it to be not in keeping with cypherpunk ideals. But, you know, I always say, what did you think mainstream adoption of Bitcoin was going to look like? What did you think when you said Bitcoin will be the base layer of global capital? What did you think that was going to look like when companies adopted that and said, yeah, we like this Bitcoin thing? So big shout out to Tim. I think he's done a fantastic job of not only, you know, I'm hoping it's not the culmination of his trajectory, but what he's been able to establish in terms of an online community around Bitcoin treasury companies and a very successful unconference hosting as well. I've well and truly enjoyed the content that's been posted. So well done to Tim. And for anybody else who's watching out there, if you're looking to enter into the space in any capacity whatsoever, I said this during the bear market, just find something that's your lane and go out there and absolutely smash it. Just throw yourself into it. Don't ask for permission. You never know what's going to stick. You never know what's going to catch on, but just find a little corner of Bitcoin that's your passion, your interest, and go out there and do it. Don't look at becoming like the 50th breaking news account. That's just not going to work. Like, it's been done. It's not novel. It's not adding any new value. I think follow what Tim's done in coming onto the scene and really making the Bitcoin treasury thing his lane and really excelling at that too. So that's a fantastic example for everybody. But I want to throw it over to you. What were your big takeouts from the Bitcoin Treasury Unconference?
Takeout number one is that this is day one of a multi-decade, century, if not centuries long trend. Pierre Rochard talks about this speculative attack. He wrote about it all the way back in 2014, this idea of borrowing in low rate US dollars, borrowing in a lower yielding currency in order to buy a higher yielding one. This is something that has been used, globally for several decades now. The most popular carry trade has been the yen carry trade, borrowing in yen and investing in US dollar assets. That's been hugely profitable for investors. And now Wall Street is only just coming around to this idea, this reality that it's highly profitable to borrow in, US dollars at a very, very low rate and invest it in a higher yielding currency, invest it in a higher yielding asset, that being Bitcoin. We're really just at day one of this process. Strategy was the very first one to pave the way. You see Stride making a great deal of announcements today. They announced they were buying Semler Scientific in an all stock transaction. That's huge from an M&A perspective. So I think that, my biggest takeaway was the general level of enthusiasm and incitement and very detailed and nuanced conversations about the way that this industry was unfolding. Look, I think, back in the 40s at the Bretton Woods conference, that was the emergence of US dollar dominance. That was the emergence of a US dollar denominated global capital market network, and everything that you've seen built since then, as far as finance goes, has been atop of US dollar rails. I think this is just day one based off what I saw at the conference, and I spoke right after Saylor, so not a tough act to follow at all. But is really that this is our Bretton Woods, right? This is the Bretton Woods for Bitcoin, the day one of what will ultimately be a multi-decade process of Bitcoin being integrated at the highest levels of global finance and becoming the rails atop which the majority of it is underwritten. I wrote about this way back in 2022. One of the first pieces that I wrote when I was brought onto the Bitcoin layer right out of my junior year of college, I wrote about this idea of a Bitcoin native yield curve. At the time, I was talking about the Lightning Network as a medium to do that. The piece was called Time Value of Lightning Network. It was a sequel to Nick Bottia's Time Value of Bitcoin that he published way back in 2017, I believe, or 2018. And at the time, I was convicted in the belief that these types of instruments, these yield-bearing instruments, would be entirely native to Bitcoin. The way that we've seen these instruments emerge is actually within traditional finance. And that's why I bring up this idea of a Trojan horse. Instead of these things happening on a Bitcoin native basis first, they are happening within the confines of traditional finance. Strategy creating these preferred stocks, Strive, building this, assembling this team in order to create a suite of financial instruments to do the exact same thing, to speculatively attack the dollar and buy Bitcoin with it, the success of Metaplanet. You only have a few key players doing this now, but what I witnessed was the fact that we're at the beginning of a trend that is going to be hugely exploding over the next couple of years in terms of its popularity. There will be players who fail. There will be people who don't do this correctly or are just purely in the space as opportunists who want to make a quick buck and then leave. But that's really what I learned, that this is our Bretton Woods moment. And I think that Bitcoin native yield curve of different financial instruments solely atop the Bitcoin network, I think that is still a future, for the world. I do believe that it's 10, 20, 30, 40, 50 years out before we see, that fully kind of consume the US dollar in terms of its usage as an asset class in global capital market rails. I think the first iteration of how we see this is what we're seeing now with Bitcoin treasury companies creating these Bitcoin adjacent financial vehicles. So it's really validating to see that idea on full display just 3 years after I had written that piece. So my biggest takeaway is that really we're, in so many words, Archie, we're really just getting started. And we talk about the institutionalization of Bitcoin, Bitcoin's monetization process. A lot of the detractors will look at what's happening here and they'll say, everyone's a shill, everyone's a suit coiner is the term that they've dubbed. But in actuality, in order for Bitcoin to grow from a $2 trillion asset to where it is now to a $100 trillion asset, you need companies like Strategy in order to bring Bitcoin exposure to corners of the market that is currently mandated away from it at this point in time. 97% of institutional capital is mandated to equities and credit. And so if there aren't companies who are creating financial vehicles for people in these markets to gain Bitcoin exposure, Bitcoin will never get from here to there. I still believe in the grassroots idea of everyone choosing to adopt Bitcoin on a personal level. But that is a very effortful campaign with very low yield, right? That takes a very long time. And it's going to continue to take several decades before the majority of the American populace invests in Bitcoin in their own right. And it's a mainstay in their 401k. The way that we get there faster, the way that we accelerate this process is bringing Bitcoin to the very institutions who've been detractors of it in a vehicle that they understand. And that will accelerate Bitcoin's monetization. And that's exactly what we're seeing right now. So that's what I would say to the detractors. This was an inevitability and we're seeing it unfold in real time. And rather than fighting what's happening, I think understanding the risks associated with it and embracing it is a much more fruitful endeavor than simply rejecting this wholesale.
Well, there's going to be money made in the financialization of Bitcoin. Why shouldn't Bitcoiners make some of that money too? Because there's a point of view that your entire financial allocation, your investment allocation should be to Bitcoin and Bitcoin only, and anything else is kind of not halal, it's not kosher. And I'm like, why? Where did that view come from? I don't really understand. I mean, if your personal circumstances dictate you have a greater appetite for 5% or 10% or 15% of your net worth, what's wrong with participating in the Bitcoin economy and helping that financialization of Bitcoin?
For sure. So there was a piece written now over 10 years ago, actually. And for everyone who hasn't read it, I encourage you to go. I encourage you to go to the Nakamoto Institute, nakamotoinstitute.org, and read it. It's called "Everyone's a Scammer" by Michael Goldstein, September 11th, 2014. And it's funny, the suggested background reading music is from one of the Clint Eastwood movies where he was a cowboy, one of the three in the Dollars trilogy. I can't remember which one it was, but go and read that piece. It's essentially about how everyone will be trying to make money off of you. Everyone will try to convince you that this is the next Bitcoin. Everyone's out to get you. The only thing that you can do is buy and hold Bitcoin. And I completely agree with that. But by the same token, plenty of people have taken that as a religious belief, and anything that seems not kosher, to use your words, they outright reject instead of trying to understand it. And this is kind of the honey badger Bitcoin maximalist, right, if you will. I'm a Bitcoin maximalist. I think that the reason there is so much vitriol toward the Bitcoin treasury companies is because they're thinking that all of these things are scams. They're a way for Bitcoiners to make a quick buck. I would argue that the reason you see Bitcoin podcasters, for example, right, this whole meme of podcaster to corporate executive pipeline, is because for the better part of the last decade, last 15 years, 16 years since Bitcoin has had a market price, these Bitcoin podcasters and people who've been working in the Bitcoin space and researching it and researching capital markets right alongside it understand this asset and its utility and where it's going more deeply than any traditional financial player in the world. And so that's why you're seeing these Bitcoiners take these positions at companies. It's not because they want to make a quick buck. It's because they understand Bitcoin more deeply than anybody else, and they can help this world come to fruition, right? And so that's why you see them putting on a suit and joining these companies who are listed on the NASDAQ. It's to bring this future into fruition faster. It's not to make a quick buck, right? That's what I would say. It's not so much they're being opportunists. It's the fact that they are uniquely positioned to help this world come to fruition, to structure these vehicles in such a way that they are to work right alongside those capital markets teams who know how to structure these vehicles with a really deep understanding of Bitcoin. So that's what I would say there. It's not so much that these Bitcoiners are being opportunists by joining these boards. It's that they're uniquely positioned to understand Bitcoin as an asset and help the capital markets team structure these vehicles and bring them to market.
Was there anything that surprised you coming out of the Unconference?
The general level of enthusiasm and also lack of shilling, right? People weren't there to say, to try to sell their treasury company over another. You mentioned Michael Saylor. I was watching his talk. I was in the front row. He talked about Metaplanet, and he essentially said that, he wakes up every single day knowing he's got to work his tail off. Otherwise, Dylan and Simon are going to cook something up and run circles around him. There's a high degree of respect among these different institutions. And the conversations weren't so much like, hey, here's what we're doing and here's why it's better than yours. It was actually really, really fruitful dialogue between every single person there for the advancement of Bitcoin as an asset and the transformative power of Bitcoin as an asset. And everybody was doing their part. Everybody was recognizing the other folks in the room. People weren't vitriolic towards one another or saying that they were better than each other. It was a really fruitful dialogue about the advancement of Bitcoin and the advancement of humanity. And that's something I semi-expected, but the degree to which people were having extremely open dialogues and, they were companies that were operating in the exact same jurisdiction really surprised me and really gave me even more conviction in this space that these folks are united in a common goal. They're different companies, but they're united in a common goal. And competition is a good thing, right? Michael Saylor directly speaking about Metaplanet and saying that it's one of the things that inspires him to work so hard. That's a good thing. Because it drives every single person working in this space to offer a better product, to offer a better solution for investors that bridges the worlds of Bitcoin and traditional finance more effectively. That's the thing I'll say that really surprised me the most and gave me conviction in this. I think any Bitcoin treasury company detractor that would have gone to this conference, it may have changed their mind. If not at the margin, maybe entirely. Because if you had gone to the conference and spoken to these people and shaken their hands, you'd understand that everyone is united in a common goal, and that is bridging Bitcoin and traditional finance. everyone here, everyone there was a Bitcoiner, right? They weren't an opportunist who had a very limited understanding of Bitcoin, who were trying to make a quick buck. They really understood the value proposition of Bitcoin as an asset class and were willing to work with each other and bounce ideas off of each other in order to help us get from where we are now to where we're going to be, which is Bitcoin is a $100 trillion plus asset that consumes a lot of this capital from other areas of the market. So yeah, I would say willingness to work with one another, bounce ideas off of each other, and the unification under a common goal were the things that really surprised me the most out of the Treasuries conference last week.
I think Michael can take a lot of the credit for that. He won't take the credit for it, but he should take the credit for it, for setting that tone amongst all of those companies, actually. And when I spoke to Eric Semler in Prague, he was kind enough to come in and have a chat with me in our makeshift studio. He said he was he reached out to Michael. They had no pre-existing relationship, and he was overawed by Michael's generosity and warmth in literally sharing the playbook with him. I mean, you don't see that too often in the corporate world, where you have some kind of alpha and you're like, hey, here it is, guys. It's just let me know if you've got any questions, and supporting them, and even using his own social media presence to promote them. Every time there's an announcement from one of these treasury companies, you see Michael retweeting that. It's quite extraordinary to see. Well, it's good that they've got a fantastic spirit of cooperation. And I guess the next steps is the evolution of these companies. Mm-hmm. We briefly touched on the need at some point to commercialize, financialize their business models. And do you have any inkling of where that's going to go? I know we spoke about real estate, but anything else that sort of popped onto your radar?
Yeah, so one of the announcements today really caught my eye, and that was Strive announcing that it is purchasing Semler Scientific. And the idea behind this is to create a more efficient Bitcoin accumulation machine. That's what they've said. And so essentially, if you take a look at Matt Cole's announcement, ultimately what they want to do is make everything they do accretive to Bitcoin per share. You know, Semler Scientific has, as far as I know, a profitable underlying diagnostics business. And that is, over a long time horizon, accretive to Bitcoin per share. That's the name of the game here. That's why investors love these companies. And so whether it's through acquisition or using outside capital to create these companies, whatever is more efficient, capital efficient, these companies will do. And so, I talked about real estate. I'm harping on it quite a lot because I think it is the biggest opportunity for a Bitcoin treasury company to come in and kind of bridge these two worlds and siphon that capital away from real estate and into Bitcoin because it's such a huge market. But there are thousands of other industries that have hugely profitable businesses where a Bitcoin treasury could come in and acquire it and then use the cash flows to make it hugely accretive to Bitcoin per share. Ultimately what we've seen is the deflationary power of technology over the last couple of years, making companies that used to have, that were hugely capital inefficient, more and more capital efficient as time goes on. And so the strategic acquisition of businesses or the strategic creation of underlying businesses that are low capex and highly profitable for the purposes of increasing Bitcoin per share, whatever industry you're in, right? In Semler Scientific's case, it's medical diagnosis, is a huge net positive. We're seeing it there. I'd have to imagine that other companies behind the scenes are doing the same thing. And, hats off to Strive, hats off to Matt Cole and Jeff and the entire team over there. They're very forward thinking in terms of the way that this industry is headed. And they have a deep understanding and recognition that having a core business and being able to flip those cash flows into Bitcoin can be done at the exact same time that you are leveraging access to capital markets to increase Bitcoin per share. So that's going to be a fascinating case study 10 years from now, 20 years from now. I hope to be a professor at a university where I'm giving a lecture on that. And, I'm teaching about Bitcoin and structured finance. I hope to be speaking about them and many others. But they are, in my mind, the first example of a company who's working to execute on this idea. And I have no doubt in my mind that we're going to see many more over the coming months and years ahead.
Do you think that's the starting gun for consolidation in this sector? Because it does appear to me that scale does matter when it comes to financing and access to financing as well, size of your balance sheet. And I do wonder, is this the starting gun to consolidation in the industry? Are we going to see a bunch of M&A activities or transactions in this space?
I have a feeling so. Yeah, I have a feeling so. In the same way that, highly profitable banks work to acquire other banks, I think the exact same thing will happen with Bitcoin treasury companies. We just saw the first major example of it. They announced their intention to buy Semler. I think that's going to happen more and more, right? So whether it is a currently private company, currently private Bitcoin company that gets acquired by one of these treasury companies, or whether it is a just a normal company that a Bitcoin treasury company views as integral in the strategic process of scaling their Bitcoin strategy operations. This really is the start of something much bigger. You can kind of looking at banks would be the best example of the way that these things will unfold. You start with a high amount of regional banks, and then from there, the highly profitable regional banks purchase all of the other regional banks and become national banks, and then eventually multinational banks. So I think that exact same process is underway now for Bitcoin treasury companies, and Strive is the first example of that. So to answer your question, I do believe this is the starting gun, and I think that ultimately is good for Bitcoin, right? What you want is a couple of major players who are out to make themselves the most efficient Bitcoin accumulation engine out there. You have Strategy, you now have Strive, you have Metaplanet over in Japan. The more people who attempt these things and put out a valiant effort and are profitable, and then these Bitcoin companies acquiring them, I think that's hugely important, and I think it's great because you're consolidating the amount of talent that you have as well. A lot of these companies' success, it boils down to their operators, and we'll see that over even more in the coming years. Who outperforms who? It comes down to your operators, and so strategic mergers and acquisitions allow you to consolidate your operators and make a more fully fledged team that can execute on this strategy more. In my mind, I think having a team of 20 really, really great operators all under one roof working to execute this strategy is better than having all of those 20 operators scattered to the winds and doing different things. It allows you to achieve scale much more effectively, and that's the name of the game with these treasury companies. So I think we're going to see a lot more of that.
So given that scale is major impetus to raising more and more capital and be able to compete in this space, and we are in the accumulation phase, how long before a major fund manager...
Whoopsies.
You want to check on that? You want
to? Yeah. No worries. We can continue. No. You can, if you want to ask that question again.
No, we're not going to edit this. This is hilarious.
Oh, beautiful.
So how long before a major fund manager, something like one of the Blackstones, BlackRocks, whatever, launches their own Bitcoin treasury company, because their access to capital markets is unrivaled? And they're often the ones selling the products, right? So, would there be any particular angle that would appeal to them?
I think, and for those watching at home wondering why that just happened in the background, this is a new office with fresh paint. So, and those are held up with command strips.
Command strips.
That's why the Bitcoin sign fell. I hope you don't take that as a bad omen for Bitcoin watching at home. But in my mind, the way that this actually plays out is instead of building an in-house team for this, they just acquire one of these other Bitcoin treasury companies. But they have to do it before they achieve massive scale, right? Strategy right now, I believe their market cap is still well over $100 billion. They are a massive, massive company. I could be wrong there, but they're a huge company.
It's in the ballpark. I think it's in the 90 to 105, 10.
Now.
Yeah.
So ultimately, for these major institutional players, it's still kind of a footnote, right? The BlackRocks of the world, the Fidelities of the world. But there has to be some internal rumblings and some internal discussions about potentially they're weighing the opportunity cost of building this firm in-house themselves and how long it will take them to achieve their ends, right? Increasing Bitcoin per share more profitably than others versus or more quickly than others versus just acquiring one of these other companies outright. I think you see the latter. I think you see the BlackRocks of the world, the Fidelities of the world, and others look to acquire one of these companies before they build an in-house team themselves. And that's purely because, again, the market has kind of voted that really all it wants at this point, I think, as I said, that will merge into also desiring a highly profitable underlying business. All it wants at this point is a team who is solely dedicated on increasing Bitcoin per share. And, having that under one roof, under one ticker, I think that if BlackRock, if Fidelity were to build out that team themselves, then that would not be a conflict of interest necessarily, but I think the market wouldn't like that too much because their team isn't dedicated to doing that. They're not operators whose foundation is that, but rather they have other goals, right? They're an asset manager. They create different financial vehicles. They sell them to, retail investors and institutional investors and other shops and things like that. I think the path of least resistance for one of these asset managers that's sitting on a lot of capital is to just acquire one of these other firms. And so, you kind of imagine it as, you have sharks and you have killer whales, you have sharks, you have shrimp, etc. Relative to the BlackRocks and Fidelity of the world, Bitcoin treasury companies currently are shrimp. They are very, very small and they're easy to acquire. And so I think over the next 12 to 18 months, one of these big firms may be acquired by BlackRock, Fidelity, and others, rather than them trying to spin up a team themselves and enter the game. And I think that will be done strategically because the folks that have executed on this strategy are a far more profitable asset than just executing this strategy on their own. And I think what that will allow them to do is give that Bitcoin treasury team immediate access to the ability to raise much more capital because now they are owned by one of these big institutions that can raise capital better than anybody else. And that will basically allow them to get that acceleration and achieve that scale without having to build that team in-house and then potentially underperform these other companies.
So we've seen Blockstream now through Adam Back about to parlay their 15,000 or so Bitcoin into a Bitcoin treasury company. Now, there are other companies who have a similar amount of Bitcoin, if not more, laying dormant, for want of a better word, not really being put to use. It's just sitting on a balance sheet. And specifically, I'm talking about Bitcoin miners. Mm-hmm. Do you think there's a possibility for them to parlay their Bitcoin holdings into sort of a consolidated Bitcoin treasury entity and to help get something to scale? Because I don't think any of them have done that yet. But there's probably, 4 or 5 of them with a combined total well in excess of 100,000 Bitcoin, I'm guessing. I mean, I can't remember the last time I checked their balances. But, there's a considerable amount of Bitcoin sitting on their balance sheets collectively. And I just wonder what the hell they're going to do with it unless they're going to sell it at the bottom of the bear market again.
So I believe that the miners will not spin off the traditional sailor playbook and run this treasury strategy. Reason being, all of the capital raising ability, all of the scale that they've achieved needs to go into their mining operations. These are really high capex operations that are hugely reliant on their ability to raise capital cheaply. And so all of a sudden, if you take that ability to finance and take that ability to raise capital, and then you put it towards something that is not Bitcoin mining, that is not your cash flowing business, then all of a sudden you underperform as a miner, and then you put yourself at immense risk of having to shut down your operations. So I think that, and this is why I said so many times when I talk about an underlying core business as being low capex, right? Highly profitable, low capex company. That's why I don't think miners will adopt this playbook and speculatively attack the dollar, because they need all of that capital raising ability, the ability to finance all of their machines and all of their operations and strike deals for good real estate with good electricity prices. All of that needs to go to their mining operations. I don't think they will have the capacity beyond that to successfully execute on a playbook. And that's why you've seen players like Mara not really engage so much in the Sailor playbook. They dabbled in it. I think, time slips by in the Bitcoin industry. I can never remember dates, but it may have been sometime last year where they announced a big Bitcoin acquisition. And then beyond that, you don't really see them running the playbook. And I think that just comes down to their core business has needs for capital markets that really take up all of their ability to go and run this playbook. So I don't think miners will be doing this as much. And that's why I think it's important to distinguish between companies that hold Bitcoin on their balance sheet and companies that are running this playbook. I think companies that are running this playbook now have been able to do it successfully without having a low capex, having an underlying business beyond, just selling the common stock and creating preferred stocks and using that to accumulate Bitcoin. I don't think, and I think that beyond that, these companies will evolve to either acquire or build low capex businesses. But because mining is so capital intensive, I don't think those will be the folks that actively run this playbook. I think miners will stay miners, and the treasury companies that run this playbook will be an entirely different class of company.
So I don't think I asked my question in a very clear way. I wasn't asking whether or not Bitcoin miners would run the Bitcoin Treasury playbook, but rather use their Bitcoin on their balance sheet, invest it in an entity, which would then become the Bitcoin Treasury company itself, and the miner would continue being the Bitcoin miner. Right. So it would just take a stakeholding, use their Bitcoin to own some equity in a Bitcoin Treasury company, similar to what Blockstream is doing. They've got, 15, 20,000 Bitcoin. They're parlaying that in a new Bitcoin Treasury company entity, and they will take a stakeholding in that by contributing their Bitcoin.
Right. I think that's going to happen. Sorry for misunderstanding the question. I got
No, it was my fault. I didn't ask it properly.
my massive Bitcoin sign fell over behind me. I'll have to fix that. But yeah, no, I think that's plausible. You've already seen it with Blockstream. You're probably going to see it with Marathon and a handful of these Bitcoin miners who do this very same thing. And it's really smart to essentially participate in that and spin it off into a separate entity rather than doing all of it in-house. I think that's plausible. Yeah. To answer your question in a much shorter fashion, I think that's plausible. I think you see more of that. Yeah.
So we've spoken about the evolution of the Bitcoin market, the financialization, and the adoption of corporates, in particular Bitcoin Treasury companies, a phenomenal success since, ever since Saylor really started doing this. It's just been evolving, punching one hole after another in the capital markets, and the capital just keeps pouring in. They're finding newer ways to attract capital. So I'm really interested to see how this whole thing develops from here. But let's start talking about I guess what's of deep interest to some of our retail noobs, including myself, which is a Bitcoin market cycle. Bitcoin Treasury companies are, to a large extent, dependent on this cycle as well. We seem to have a lot of capital flowing in when the price shoots up. Investor interest also shoots up, follows, and then the capital pours in. We saw that earlier this year from around March, April. And then as the Bitcoin price sort of consolidated, we saw their share prices also decline as well. So where are we right now? I mean, it's been well and truly, is it 2.5, 3 years now since the bottom of the bear market? That's quite a long time. I mean, we typically are at the pointy end of a 4-year cycle by this point, which has led a lot of people to suggest perhaps there really isn't all that much longer to go. And so people who have been around a little while or have opened up the long-term chart think, okay, when's the parabola coming? And so my question to you is there going to be a parabola, or are we simply going to get 20 years of what Amazon did after the dot-com bubble, which is essentially just, climbing up this hill with the occasional trip, 40, 60% drawdown that only lasts about 6 or 7, 8 months rather than, these 2 or 3 year bear markets. And so how do you see the evolution of the Bitcoin cycles? Do you think they're broken and we're actually entering into a new epoch?
So we will have to wait another few weeks and another few months to really see that. In my mind, I think Bitcoin is fundamentally changed in the way that it behaves. I do believe that the 4-year cycle that is really tied to several months, if not a year or so after the halving, that's somewhat falling to the wayside. I think Bitcoin's upside reflexivity is here to stay because of the halving. But I think the way that Bitcoin's price behaves in terms of doing nothing for a really long period of time and then taking about a year where it shoots up and then followed by another 1.5 years of a bear market, I think those days are behind us. Reason being, really the bulk of the bull market, the last 4-year cycle that we experienced, all of it really came in the middle and end of 2020, all through the middle of 2021, right? So what you're talking about is about a year to maybe 18-month period where the entire bull market happened and then the bear market ensued after that. What we've seen is that since January of 2024, and actually, prior to that, or January of 2024, when these ETFs were launched, is that Bitcoin has behaved a lot differently. In the lead up to the launch of the ETFs, there was a great deal of anticipation, 6 to 9 months of awaiting these vehicles awaiting these vehicles' imminent SEC approval. You saw Bitcoin chop around and then make a huge leg higher toward the end of 2023 into when these ETFs were launched. And since then, you have kind of seen Bitcoin behave in a stair-step fashion, is what I call it. Instead of having 3 years where nothing happens and then a huge rally, this parabola that you mentioned, followed by a blow off top, what you've seen is a fundamental change in the way that Bitcoin behaves. It chops around for a little while and then stair steps higher, right? The kind of mini parabola per se. And then it chops around and then it stair steps higher. We saw this from, basically Bitcoin chopped around at or around $15,000 to $25,000 for about a full year. And then it shot up in anticipation of the ETFs. It shot up to a brand new all-time high, close to $70,000 when the ETFs were launched. It chopped around between $55,000 and $70,000 for about 6 or 7 months. Took a huge leg higher to above 100,000. Chopped around, dipped back down to 800,000 or 80,000 rather. Took another leg higher to about 110,000. Chopped around, took another leg higher to 120,000. I think that's the name of the game for the way that Bitcoin behaves from here on out. Purely because what you have now, what dominates Bitcoin in the same way that what dominates the S&P 500 is passive flows. Obviously, there's a huge amount of spot buyers who DCA every single day. Those are sort of the Bitcoin native passive flows, if you will, who set up an automatic DCA. But the lion's share of passive Bitcoin purchases that come today come through purchasing these spot ETFs, right? Through people's 401ks, through their IRAs. And that's why you've seen much more muted yet volatile to the upside price action for Bitcoin. When it comes to investing, in the S&P 500 passively with every biweekly paycheck, you tend to not see a lot of downside chop. There are periods where that are a couple months long where the S&P 500 doesn't do too well, but a bull market is largely up and to the right, right? It's not this typical Bitcoin behavior where it's kind of flatlined for a while, it's consolidating, and then all of a sudden it has about a year where it explodes to the upside and outperforms everything, followed by this insane 70% drawdown. I wouldn't say those days are behind us, but I do think the behavior of Bitcoin is becoming more tightly correlated with the S&P 500. If you take a look at the 30-day rolling correlation between Bitcoin and the S&P 500, it has grown tighter because Bitcoin is trading with higher beta to the rest of the stock market because the underlying buying behavior of the asset is morphing into something that looks like the rest of the stock market. And so that's why, Bitcoin's downside volatility has been somewhat muted. It's because its buying behavior has fundamentally changed. I think as that continues, as people continue to allocate more and more to these spot Bitcoin ETFs, and these ETFs buy Bitcoin on behalf of their clients, it's going to continue building this really tight correlation with the direction of the S&P 500 before, let's say 10, 15, 20 years from now, where it just breaks all correlations entirely. And it's an asset that does well regardless of the macro environment. Essentially, it becomes a stronger risk-on asset, a higher beta risk asset before it becomes an extremely uncorrelated asset to the upside. So I wouldn't say the 4-year cycles are dead, but I would say that the buying behavior has fundamentally changed. And we have to be on watch over the next several months because if Bitcoin's 4-year cycle is still alive, then over the next several months, you'll see whether or not we've topped out. I tend to believe that September is generally a really poor month for Bitcoin. It's Bitcoin's worst month historically, but it's followed by its two strongest months, October followed by November, which are the second and first strongest months for Bitcoin respectively. So I think that there's a lot to learn by keeping an eye on the charts and keeping an eye on historical analogs over the next couple of months. So I won't say Bitcoin's 4-year cycle is dead. What I will say is that Bitcoin's buying behavior, it's the cohorts that purchase Bitcoin passively have fundamentally changed. And we will see whether or not the old correlations and the old market cycle behavior holds over the next 2 months. If Bitcoin does very well, if by the end of the year, Bitcoin goes up to 150, 160, 180, maybe, then I would say, the 4-year cycle may have gone to the wayside. It may have less of an impact on Bitcoin than it did previously. But if Bitcoin underperforms into the end of the year, if $124,000 and some change was the top, then we can confidently say that Bitcoin's 4-year cycles have not fallen to the wayside yet.
Yeah. Have you do you follow Tech Dev on Twitter?
I do. Yeah.
Yeah. Have you seen his chart? I really like his charts, and one of his charts tells the story that basically the business cycle is about to turn, and Bitcoin has never peaked before the business cycle has peaked, and we're just about at the bottom of the business cycle, about to turn up.
Yeah. No. So that's a very good observation, right? Ultimately, the Fed is They just did their first maintenance rate cut last week. It was funny. It happened on the day of the Treasuries Unconference. So I think it's the first Federal Reserve meeting where they had a rate cut that I wasn't present and like actively talking about it on Twitter in forever. But ultimately, what you are seeing is a Fed is cutting interest rates. They plan on cutting interest rates over the entire next 12 months through July next year. There are a total of 100 basis points worth of rate cuts that are priced in. Those haven't changed much. If anything, they've actually come a little bit in. So the market is expecting fewer rate cuts to happen at the margin. But 100 basis points in total worth of rate cuts priced in over the next year. And so ultimately that eases credit conditions. That means the business cycle will turn up, right? Ceteris paribus. Ultimately, the Fed does drive by looking in the rearview mirror. And so the data that the Fed makes decisions on is not data that's coming in and it's, on the day. That's exactly what the economy is doing. So it remains to be seen if the Fed is too late to cut and the economy is already in a downturn. And as a result, people pile into U.S. Treasuries and they divest from risk assets and the Fed cuts even more aggressively. If that were to happen, risk assets would underperform into the end of the year and the beginning of next year. If the economy holds relatively robust and the Fed, by doing these incremental 25 basis point rate cuts, is able to support the economy, ease credit conditions, and make it so that businesses have more easy access to credit, banks loan more money, people move out on the risk curve, then that chart will kind of hold true, right? Bitcoin may not have peaked for the year. It all boils down to what the economy will do and what the Fed's reaction function is. Right now, the Fed's reaction function to data is when data is coming in and it is resilient, they are cutting. Ultimately, over time, the Fed's reaction function to poor economic data during a cutting cycle has always been to cut more aggressively. I'll pull up the chart now so it's in front of me, if I have it in front of me. You saw during the last rate cutting cycle, which actually began to the day, funnily enough, when we cut rates this time, September, actually one day later, September 18th last year is when we cut rates by 50 basis points. September 17th was when we cut rates this year by 25 basis points. They have always adjusted their rate cutting cadence based on the incoming data. So they did 150 basis points rate cut, potentially an admission that they had waited too long, and then they followed it by two incremental 25 basis points rate cuts, and then they stopped. Right now, the Fed is cutting incrementally in 25 basis point chunks, and depending on incoming data, they may cut more aggressively. But the reality is that when the Fed is cutting interest rates into a relatively resilient, cooling economy that does no longer has this extreme inflation risk, then risk assets do well. You'll note that the last time the Fed cut interest rates, Bitcoin continued channeling around a little bit. Ultimately, between its first and second rate cut, Bitcoin rose 13%. And then ultimately, once the Fed was done with his rate cuts, Bitcoin rose 54%, right? So from $60,000 roughly to over $100,000 by the time the Fed was done cutting. And then ultimately, we were on hold there for the entire year. And then, we ended up doing quite well this year. It all boils down to what the economy does. In 2022, the Fed was too late to the party. Inflation was too big of a risk. They started raising rates in 25 basis point chunks. And then they ended up raising rates in 50 basis point chunks for the remainder of the cycle until their last two cuts. I believe somewhere in there, they even did 270 or 375 basis point increases, actually four. So all throughout 2022, they did 1, 2, 3, 4, 75 basis point rate increases. They tightened really aggressively because they were late to the party. If the Fed is late to the party and they wind up doing more aggressive rate cuts, you will likely see Bitcoin underperform in the near term and resume its outperformance in the long term. A very long-winded way of saying it all depends on whether or not the Fed was late to the party. If the Fed wasn't late to the party and we are really at the bottom of the business cycle, Bitcoin will continue doing well. If the Fed was late to the party and we still have yet to see the bottom of the business cycle, the Fed cuts more aggressively as a result of economic data coming in and showing a continued downturn, then we are not at the bottom of the business cycle and Bitcoin will underperform. So it remains to be seen. We've got to keep an eye on the data and how the Fed reacts to it.
So that's how the Fed might react. I guess that's your reading of them. But what's your reading of the macro conditions right now? Do you think they are late?
I don't think so. I don't think so. I think what you've seen is a relatively stable and robust economy from a PMI's perspective. You have seen some underperformance. You have seen job revisions to the downside, majorly to the downside as well. I think earlier this month or late last month, an entire report, I believe over 1 million jobs were revised away, something like that. And so the Fed ultimately operates on poor data, and revisions are always no fun, right? Showing that the economy wasn't as resilient as people thought. So I think the Fed is doing the right thing. I think they're cutting at the right time. I think risk assets will do well into the end of the year. But that remains to be seen, right? Next week, or actually later this week, on deck, we've got S&P manufacturing PMI and services PMI. Depending on how those do, if those come in massively below expectations, then the Fed will continue to be proven to be late to the party. If those come in roughly in line with expectations, the Fed is probably moving where they should. But to this point, I think the data is coming in. It's showing a cooling economy. And the Fed is coming in my mind, at a pretty good time to come in and support it. But we'll have to see. Data is always changing. For example, for the first time, I don't know if in history, but the BLS actually came out and said that they were not releasing a key inflation report. They were missing the deadline for an inflation report. That's never happened before. I think there needs to be a referendum on the effectiveness of the data and the agencies that report this data. But to my eye, just viewing this economic data from the outside in, I think the Fed is coming in at a good time. They should have come in a little bit earlier in my mind. The U.S. Treasury market tends to tell the Fed what it should do. For example, the 2-year yield has been inverted to the federal funds rate for several months now, meaning the market has believed that short-term yields should be lower than they are relative to where the Fed has them. And when that happens, that means the market is saying, hey, Federal Reserve, you need to cut interest rates. And that had been the case for a decently extended period of time, a several month period where that was the case, where the market was essentially telling the Fed that rates needed to be lower. So we'll have to wait and see how data comes in, how the market reacts to it. Currently, the market's reaction to the Fed's rate cut has been relatively positive. Over the last month, the S&P 500 is up 4%. Over today, the S&P 500 is doing okay. It's moderately flat. It's like plus 0.38%. The NASDAQ is doing okay. The Russell is doing okay. Bitcoin has not done well in the face of this rate cut. It is down at the margin. So we will see where we're at. I know it feels like a non-answer, but I never like to go out ahead of my skis. I think the Fed cut may be a little bit too late, but I don't think it's something catastrophic.
So if we are at the bottom of the business cycle, or business cycle is about to turn up, and we've got potential rate cuts coming up, so like how far can the upswing run, and what can we expect in terms of, I guess, I'm going to ask you for a price prediction and a time frame as well. So the end of this year is probably too short a time frame to be able to make a projection. But if we look down 12 months down the track, or the end of 2026, where could Bitcoin potentially be if those rate cuts eventuate and the business cycle upswing takes effect?
Yeah. So I think that, a moderate prediction, a pretty reasonable prediction, is that Bitcoin could run to $150,000 between now and year end, maybe even 180 in the event that the business cycle is massively supported and we get this huge upswing as a result of the Fed's cuts. These are pretty measured cuts. These are maintenance rate cuts, right? They're not these massive wholesale, we need to change the cost of capital overnight, let's cut in 50 or 75 basis point increments. So this is a multi-month process. If the market decides and they're convicted in the belief that the Fed will cut rates all the way down to 4%, where they're currently estimated, 3% between now and next July, which is what the estimate is currently. Currently, the Fed funds upper bound is at 4.25%. The implied rate for the upper bound will be at 3% by next year if all these cuts go through. If the market believes that will happen, and they're convicted in their belief that that's where the neutral rate is, then risk assets will do well into the end of the year and into next year, right? Between now and when the Fed eventually arrives at that neutral rate. The thing is, the 2-year U.S. Treasury yield right now is 3.5%. The market's estimate for the upper bound on Fed funds for next July is 3.1%. So the market is actually saying that the economy is doing quite well, or better than the Fed is thinking, right? They believe that rates don't need to go as low as the market is currently pricing it in, as what the market believes the neutral rate should be. So, it really all depends on, again, it depends on the data. It depends on how the market is reading that data and interpreting it. If we do wind up with a reinflationary risk as a result of these Fed cuts, if the business cycle takes too big of an upswing, if data comes in and it is too positive, then you run the risk of Bitcoin not doing very well in that environment. With the Fed not doing as many cuts as it said, the Fed being in an on-hold kind of waiting period. But in the long term, of course, Bitcoin stands to do quite well. I'd say a pretty conservative year-end estimate, if we really are at the bottom of the business cycle or near the bottom of the business cycle, we only have 3 months to go until the year is over, would be something like $150,000 to $180,000. If we have yet to reach the bottom of the business cycle, if it proves that the Fed is actually too late to the party, 124,000 may have been the top for the year. That's me thinking probabilistically and dependent on the data.
Yeah, well, if it does hit 180,000 by the end of next year, that's well and truly above the compounded annual growth rate of Bitcoin anyway since last year. For example, what are we at the moment? 112,000. And we hit 100,000 just before New Year's Eve, didn't we? What was it on January 1st? It was about 98,000.
Yeah, on January 1st, we were, let's see here, 97,000.
97,000. Okay, well that's not too bad year to date, and so if we can get a few pips above where we are right now, that's a bang on target of 20%, and then next year we could get another 50 or 60, 70%, and it sort of averages out to a pretty good compounded annual rate of growth. But you'd think that you'd think that if we do continue on this rate for the rest of this year, that there'd be a fair bit of capital sort of lining up to come back into Bitcoin. I don't imagine that we're going to get these long 12 months drawn out bear markets anymore. It just doesn't seem likely. There are too many buyers coming in from different pools of capital, and I think we've got the Bitcoin Treasuries, we've got the ETFs, we've got retail, we've got the maxis DCAing. I just don't see a prolonged bear market like we've become used to in the previous cycles. And I love pulling up the long-term Amazon chart on the monthly and just having a look at how that's behaved over such a long time. It's just been perfectly within a channel, with occasional every 2 or 3 years having a fairly steep but very short-lived drawdown. And I just get the feeling we are entering into such a channel now, and it could run for 10, 20 years, just like it did for Amazon. So I think max pain might be people anticipating a 4-year cycle.
I think so. Yeah, no, I think that right now, the longer you see Bitcoin spend at these levels, the stronger it becomes. For example, I put out a tweet, and I'll actually pull it up right now for my reference so I do not misspeak here. During the 2021 top, right, when Bitcoin reached above $60,000, Bitcoin only spent 40 days above that mark, above that $60,000 mark, and it experienced extreme volatility. I put this tweet out 3 days ago. Bitcoin has now spent 70 days above $110,000 with extremely low volatility. And so ultimately what you see there is the maturation of an asset. You see an asset that is at these extreme levels that at one point in time may have been overextended. They are now considered a base for Bitcoin to move on from. And so when you see lower volatility at these areas where Bitcoin is historically elevated, that's ultimately that ultimately works in Bitcoin's favor. That's telling you this asset is becoming more mature and more stable over time as it grows in size. When Bitcoin was $60,000, it was roughly a $1 trillion asset, $1.1, $1.2 trillion asset. Now it's double the size. And so you need double the capital to make those exact same moves. So not only from that perspective, Bitcoin obviously will have lower volatility when it's double the size, but it also tells you that the people who are holding this asset are far more mature investors who are holding this for a very long term. ultimately what you've seen over the last several months in terms of Bitcoin's price behavior is Bitcoin taking another step up and then consolidating for a very long period of time. And what it's doing there is you're shaking out all of these sellers. You are shaking out the folks who consider this an overextended level, who potentially got in at this level and want to cut their losses, or people who just consider this a top and they want to divest from it. And so ultimately, the more time you spend here, the better. The longer Bitcoin's time is spent here, it means that the coins are shifting from all of the sellers to buyers, and they're able to hold this line, right? Instead of these sellers overwhelming the buyers and then Bitcoin going to 100 or 95,000 or 85,000. So the longer Bitcoin spends here, the more confident people should be that we will experience another leg higher. And another point to Bitcoin's maturation, you saw Galaxy facilitate the single largest sale of BTC in one order. It wasn't one order, obviously, but the single largest sale of BTC in history, 80,000 Bitcoin over the course of, I think, 5 days or a week was sold off from one entity, and the market didn't flinch. It didn't move. It didn't even go down. And so Bitcoin is a mature enough market to absorb those huge sales. I think $100,000 and above $100,000 is a huge psychological level for folks who may have been in the market for a very long time. And so it's no wonder that there's a lot of selling pressure here, and it's no wonder we're spending so much time here. I think the more time we spend here, the more confident people should be in Bitcoin's long-term trajectory. And ultimately, from a just a market dynamics perspective, it means that we now have a much firmer base to move from. The more time we spend here, the more used to this price of Bitcoin that people are, the more strong of a base that we have to launch from for the next leg up.
So I remember in 2021, Elon Musk famously sold a bunch of his Bitcoin, or Tesla's Bitcoin, and he used the phrase "testing liquidity" on the exit. And so I just want to touch on that point about Galaxy facilitating a transaction or sell transaction of, was it 80,000 Bitcoin, and Bitcoin hardly moved even 2%, even if it did that, and it bounced up pretty quickly. Mm-hmm. Tell us why that is an extremely bullish signal to capital markets.
Yeah. So for me, looking at this, right, Bitcoin has historically been a very niche asset, one that nobody takes seriously. Just 4 years ago, the Jamie Dimons of the world, the Larry Finks of the world were the most outspoken Bitcoin detractors. And now they have morphed into Bitcoin advocates. Obviously, Larry Fink has a product for Bitcoin. Of course, he would want to talk his book from that perspective. But, from 2021, when news like Elon selling a lot of Tesla's Bitcoin can cause a huge plunge in the price, compared to 2024, where an 80,000 Bitcoin sale can be done and the market barely moves an inch, it brings more confidence from institutional allocators that this is an asset who has extreme depth and liquidity and extreme long-term value. Before, if you heard that somebody was selling $80,000 Bitcoin, that news would spread far and wide and it would cause other people to sell. And now it caused no panic whatsoever. In fact, it imbued people with confidence. It imbued institutional asset managers with confidence. And so I think it's a net positive. I think you will continue to see these large Bitcoin transactions on both the buying side and the selling side. Institutional allocators will continue to be very impressed by the depth of liquidity in Bitcoin and its ability to absorb these sales without price shocks. And that just brings more people into the market. It brings more eyeballs to Bitcoin for people to start taking it seriously and learning what it is as an asset. It's just another step in Bitcoin's institutionalization, right? It was kind of a gut check as to whether or not Bitcoin could handle this, and it handled it extremely well. With the sale, there was barely any slippage. Barely anybody knew about it. Galaxy announced it after the fact, and if you were just checking the price action every day, you wouldn't have been able to tell there was a huge Bitcoin sale or a panic that came with that sale. So the lack of panic in the market, the lack of slippage from a price perspective during the sale and then after the sale should imbue retail, anybody watching the show, and institutional allocators with huge confidence. And now people are looking at that, and it's just another thing in Bitcoin's corner for folks to look at and consider it a much more mature asset than it has ever been before.
Yeah, just going back to that Elon Musk transaction, his interest in Bitcoin, his purchase, it was peaked around about November, December, and he wasn't even sure whether or not it would be possible to buy more than $1 billion of Bitcoin. And he famously posted on Twitter, "Is it even possible to buy Bitcoin in such volumes?" And Michael Saylor offered to show him exactly how he did it. And he said, I'll show you my playbook. And presumably they had a conversation in the or offline, because, within weeks, Tesla announced, I think it was $1 billion position, $1.5 billion position in Bitcoin. But the question still remained, you can buy it, but can you get out of the position without really taking a huge loss? And I think he proved that he can. He could, because he was selling, he made that sale well after the peak of the Bitcoin price, but before the catastrophic the bear market plunges that we saw. So I think it was around, it was well north of 40,000, maybe 45,000. So to see what Galaxy was able to achieve with an 80,000 dump and with barely a blip on the candle, so that was extremely encouraging to all sorts of people with deep pockets, because now they know they can get in and they can get out, and liquidity is not a problem in a $2 trillion market. I think it's $2.3 trillion market. So it was incredibly encouraging to see that. I was so happy to see the fact that not only did nobody panic on the timeline, but the market just absorbed that so well. So in addition to, maturing as a market, we're now seeing much larger players get the green light from regulators and also market conditions to enter Bitcoin. So we have a number of different, I guess, pipelines of capital into Bitcoin right now. Do you have any idea of what the average purchase from Bitcoin Treasury companies layered upon ETF average buys over, like, 2-3 months? Because ETFs seem to ebb and flow, but when they buy, they seem to buy between about 500 million and about $1.5 billion every 7 days, when the market's really pumping. But I haven't really got my finger on the pulse with respect to Bitcoin treasury companies and what they're purchasing. Have you had a chance to look at that yet?
Yeah, so you see, so Strive announced, a purchase that was in excess of 5,000 Bitcoin, or right around 5,000 Bitcoin.
Yeah.
Nakamoto did the exact same thing in excess of 5,000 Bitcoin. Strategy has tamed its purchases. Every week they're buying 500-ish Bitcoin, these small little increments. And so you total all of it up between the players that are stateside and the players that are, international. And you are looking at, a cadence well in excess of, 1,000 Bitcoin a week, during good periods, during strong accumulation periods, between 5,000 and 10,000 BTC every 2 weeks, every month, if not more, right? 20,000, 30,000. You layer that on top of these ETFs who are experiencing these passive flows. Obviously, again, it's reflexive to the price. It ebbs and flows. But exactly as you're saying, you're looking at several hundred BTC per day from these entities. Over a week, you're looking at several thousand. So over the course of, a year, particularly in a very strong time, tens of thousands, if not hundreds of thousands of BTC being purchased just by these two entities alone, not to mention individuals, not to mention private companies who are not announcing these things, who may be buying spot Bitcoin incrementally through services like River. And what you ultimately have is a very distributed amount of people who are purchasing Bitcoin, and very varied types of entities who are buying Bitcoin as well. And that adds to Bitcoin's resilience. We think about the wealth effect. You think about the people, when Bitcoin was primarily a retail phenomenon and it was just individuals buying Bitcoin. That made it so that buying and selling was much more reflexive than times prior. When you have a more mature market, entities are buying regardless of what the price is doing because they believe in the long-term trajectory of the asset, right? Smart investors, when an asset is down, they want to buy more of it, versus retail investors who do the exact opposite. They want to pile in when Bitcoin's price is doing well, and they get fearful when Bitcoin's price isn't doing well, and they sell. And so buying and selling is extremely reflexive to price. Price movements are extremely sensitive. We're moving into a world where that's not the case. Not only because you have a lot more variation in the entities who are buying Bitcoin, but also the entities who are buying Bitcoin in size now are buying and holding, right? They're not buying and holding for a period and selling. They're not buying because they're excited about this thing and their friend told them about it. They're buying for the long term and they're not selling. So that is massively great news for Bitcoin stability. And so, and this happened in a very short period of time as well. I don't think many people appreciate that. Within the span of just a couple of years, right? If you compare 2021 to 2025, that went by in the blink of an eye for me, right? In terms of just keeping my head down and working. But in actuality, in all essence, in terms of finance, it is a very short period of time, 4 years. And Bitcoin moved from an entirely retail phenomenon to a phenomenon that is dominated by passive flows and businesses. And that's a massive development because these businesses have no near-term intention to sell. They've acquired Bitcoin using very intelligent, low-price liquidation risk leverage with very, very low liquidation levels. And people who are buying for retirement who have no intention of selling for 5 years, 10 years, 20 years, 30 years. That's massive for Bitcoin. It makes it so that, selling behavior is far less prominent when Bitcoin begins to do poorly. If Bitcoin was still a retail phenomenon and we were at $124,000, and that price dip happened where we moved from 124,000 all the way down to sub $110,000, that would have caused a panic that chances are would have meant the end of the bull market, right? It would have meant the end of the bull market and kind of the beginning of the bear market, because so many people would have been fearful that they would have gone out, and they would have far outweighed any of the liquidity on the other side who are buying and holding this thing for the long run. Now what you see is every single time there is a dip, every single time there is consolidation, these entities are just accumulating, right? All of the Bitcoin that gets sold by weak hands is not getting purchased by strong retail hands. They're getting purchased by actual strong institutional hands, right? Who are not selling this thing in the near term and have no near-term plans. When I say near term, 1, 3, 5, even 10 year plans of selling this thing. So Bitcoin's a fundamentally different asset now. It remains to be seen if that will have a material impact on the way that this cycle plays out, but I have a feeling that it will.
So buy the dip is no longer a meme anymore. Exactly. It seems to be an investment plan, actually. So, but we still see, like, for example, psychological levels like 100,000, and we saw a lot of dormant OG Bitcoin wallets suddenly become activated, and so I wonder whether or not we've exhausted that yet. Have you seen any indications of that on chain?
I wouldn't, as far as psychological levels go,
because I think we have been above 100,000. I was about to tell you before when you said Bitcoin has traded above 110,000 for 70 days or something. We've been over 100,000 for 136 consecutive days, closing over 100,000. Which is extraordinary given the volatility metric that you mentioned before. So I wonder whether or not we've had enough time of eating up all of the OG Bitcoin sellers who bought at pennies and thought 100,000 is a pretty good level to cash out and start my estate planning and distribution, for example. Well, there were quite a few announcements that we saw verified on chain of very old wallets, and we're talking 11, 12, 13-year-old wallets, untouched, unmoved, suddenly becoming activated and sent onto exchanges, which is one of the reasons why I asked. I said, well, do you think we've exhausted that yet? Because it does feel like the 100,000 mark was a level at which, that triggered a lot of activations of people wanting to sell. And you know what? If you bought and you held for 10, 11 years or even 6, 7, 8 years, good luck to you. You've earned that. You've well and truly earned that through 2 cycles. I don't begrudge anyone selling. But
exactly. What's the difference between, holding 10,000 Bitcoin and getting out at, 100,000 and having, tens of millions of dollars in your pocket and you can do whatever you want for the rest of your life versus hundreds of millions of dollars, right? At some point, the dollars become totally unnecessary in order to live just the menial, normal retirement that most people want. So you're exactly right. And to answer your question, from an on-chain perspective, and then also from a just general price action perspective, it seems we're nearing the end of the folks who are selling these OG folks, 8, 10, 11, 12 years, who sold immediately after 100K. The reason being, when we initially shot above $100,000, we spent, I think, a total of 3 days between $70,000 and 100K, and $90,000, right? Literally zero volume in that area. And then we managed to go all the way up to 100,000. Sell orders began flooding the order books during that period, right? During December of last year, all the way basically through March of this year. And that sent Bitcoin from, nearly 110, like 108,000 was the initial all-time high. I remember it, to like $78,000. There was a 6-month window between, November and December when Bitcoin initially did that, and April of the following year, where it was essentially consolidation and then massive selling, right? The sellers dominated the order books and they essentially got out. So because we have now had strength enough to go back from below $80,000 up to 100K, and again, at 100K, you started to see a lot of selling again as well. We consolidated there for a while, and now we've moved up. We're at 120. There's still a great degree of selling that's being, on the other end, it's primarily older addresses. On the other end, you have institutions buying. That leads me to believe that we are nearing the end of this. And you pair that with macro conditions and what Bitcoin tends to do in October and November. I believe that, on $100,000 a psychological level, absorbing all of that OG selling is close to defeated. Because taking a look at the order books, taking a look at on-chain data, it seems to me that the majority of people who are planning on selling at 100K have sold at 100K. And we're now just sifting through the final amount of people who want to get out at this level. They're happy with what they've done, happy with what they've made. Those who purchased at or near 113 in Q2 and early Q3 of this year, who are trying to get out and sell at or slightly above their cost basis. And into October and November of this year, you're really going to see some pretty good stuff. Ceteris paribus, again, assuming the economy remains resilient and the business cycle is trending on the way up, credit conditions loosen, and people move out on the risk curve. From an on-chain perspective, it seems that we are close to exhausting all of these OG sellers who had orders scheduled or are selling now. The order books have almost processed all of those folks.
I saw a very amusing comment online in response to the news that was posted about an OG selling about $8 billion worth of Bitcoin. And someone said, but how's he going to protect himself from inflation?
Right? Exactly. Yeah.
Like,
with $8 billion, you're good.
$8 billion, I think he's protected from inflation, mate. I don't
fine.
think he's going to care about inflation.
Exactly. Yeah.
But I think that's a really perfect example of people just becoming so wrapped up in ideology, they lose sight of the dogma of the whole space, that they lose sight of reality. Like at $9 billion, inflation is not going to hurt you, my friend. It's, it might hurt your spreadsheet. It might hurt, the numbers on your bank balance, but it's not going to hurt you. You're fine. Yeah. At $9 billion, you're well and truly covered by inflation.
Yeah. Beyond some US dollar amount, the opportunity cost of selling your Bitcoin, becomes, it becomes a situation where you have made more investing in Bitcoin than you'll ever need across 100 lifetimes in US dollars. 8 billion is a prime example of that. If you are a single man with a family living in the suburb, or not a single man, if you're a married man with a family living in the suburbs, the numbers are like, okay, if you want to retire by 40 and be able to put your kids through school and have a handsome retirement by the time you're 65, you need, $9 million, right? If you have 4 kids, right? Handsome retirement. You want to retire by 40. You want to cover all your life expenses for you and your family. $9 million is about that barometer. When you're talking about 1,000 times $9 million, there's no reason to not sell at that stage, right? You don't have to sell everything, right? You can still keep 100 Bitcoin, 1,000 Bitcoin, whatever you'd like. But at some point, once you have made that money you will need in order to acquire generational wealth for your family, not just live for the rest of your life comfortably, but live more than comfortably, allow your children to live more than comfortably, and even your grandchildren to allow to live more than comfortably, right? Those goals in that order, once you've achieved all three, there's no point to continue holding this asset. May as well pass that asset along to people who want to buy it at this price. Like the broader picture here with that example that you just gave and that funny Twitter comment that you just mentioned is, don't forget why you're in the dance in the first place, right? Don't get so wrapped up in dogma that you don't understand why you're here, right? Ultimately, this is a wealth preservation tool to make sure that you can do all of the things that your grandparents did and your great-grandparents did, right? And then beyond that, the next leg up in terms of a goal would be to secure generational wealth for, right, you and your family, right? And if you could do that, then beyond that, there is little to no utility of holding on to every single Bitcoin that you hold and not flipping it for cash, which is what you use to pay your expenses in your everyday life. That's not to say selling all of your Bitcoin, but at some stage, right, never sell your Bitcoin is an investing ethos that basically boils down to like, do not trade your Bitcoin. Don't sell your Bitcoin because you want to buy a new car. Don't sell your Bitcoin because you want to go make a silly purchase. But beyond some point, if you have $1 million in wealth locked up in BTC, 3 million, 5 million, 10 million. It is prudent and it makes sense to sell a portion of it to go buy that house totally in cash. It makes a lot of sense to begin doing these things that you had withheld for a number of years, right? Don't sell that Bitcoin as an ethos that you can ascribe to when you are still in your accumulation phase and you are still kind of in that hustle and grind phase. But once Bitcoin has reached a certain point in its price, your conviction is paid off and now you can enjoy the fruits of your labor, the fruits of everything that you have struggled for and you've saved for. So yeah, kind of talking against that dogma. And it's also, honestly, an extension of the exact same dogma that is against Bitcoin treasury companies, right? The only way to buy Bitcoin is not to, have individuals at the individual level buy and hold it. That was never going to be the only way people bought Bitcoin. At some point, financial institutions and entities on Wall Street, we're going to recognize this thing and we're going to start using a strategy to accumulate it and hold it and sell debt obligations, sell common stock in order to buy more of it. That was an inevitability. And rejecting that and rejecting ever selling your Bitcoin, you can be a Bitcoin maximalist and recognize that at some point I'm going to sell, right? And I think the lion's share of people who say they're never going to sell are being intellectually dishonest.
Yeah, you've got to remember to live now. And in addition to that, there are non-monetary measures of wealth and well-being as well. So you can't measure the peace of mind that owning a family home will give you. You just can't. I'm sorry.
Bitcoin
is like you said, if you haven't made your money, that's fine. Mm-hmm. Continue to accumulate and be disciplined and hodl and all the rest of that. But if you have made some money and you don't have a family home, like, what do you want to make money for if you don't want to own a family home? I don't understand that. Yeah. Especially for someone like you, you're about to, you're a recently married man. And so the value of aspiring to have a family home, right?
Yeah, exactly. So, and, ultimately, I am very Christian. I grew up in the Christian faith. I always try to preach it as much as I can and spread the good news. And one of the roots of all evil is love of money, right? People often misquote that money is the root of all evil. That's not true. That's not what the Bible tells us. It tells us that love of money is the root of all evil. And this can be, this example that you just illustrated is that in practice. Money, right, is not the end all be all, right? There are other things in life that are more valuable than monetary assets, right? Having a family home, being able to live with them and bring them up and give them a good life. Those assets to me are more valuable than any amount that's in my checking account, any amount of Bitcoin that I hold. And if Bitcoin can be a means to an end to achieve those things sooner and more prosperously, then I'm going to take that 100 times out of 100. Because if I'm worshiping money so much that the other things in life that are more important than having a number in my bank account are cast to the wayside, then I've completely lost the plot. I've completely lost the reason why I'm here, and I'm worshiping something that I'll never be able to bring with me when I leave this earth, right? All you'll have, right, the most valuable asset you have is your time, right? It's not Bitcoin. It's not anything else. And Bitcoin allows you to take more of that time back that was stolen from you. Right? In a very real sense, at the individual level, Bitcoin is a means to an end. Instead of achieving the things you want to achieve for yourself, for your family, whether it's family formation, whether it's owning a home, whether it's being able to travel more, whether it's being able to build a business, it truncates that timeline from 20 years, 30 years, 40 years, 50 years, or never to a much shorter time horizon. So you can achieve those things you want to achieve that you felt priced out of, that you felt despair because you couldn't get to. And if you lose sight of that, right? If all you care about is staring at the number going up and saying, look at how much money I have, I'm never going to achieve these other things in life that I want to, then I think you've well and truly lost the plot. And you've allowed the love of money to supersede everything else that you had, that would otherwise bring joy and fruit to your life.
Brother, well said, man. Joe, it's been an absolute pleasure. Tell people where they can find you and give your business a plug as well.
Absolutely, Archie. This is, I think, the longest podcast I've ever been on, and I had a good time. I hope you enjoyed my inane ramblings, and I hope everyone at home enjoyed my inane ramblings as well. If you want to find more of me, you could just search up at Joe Consorti on X. I'm sure it'll be linked in the description. You could also go to my YouTube channel. It's just my name, Joe Consorti. I post all of the videos that I post on X over there as well. And if you want to learn more about Horizon, the sign that didn't fall down in the background, you can go to joinhorizon.com and learn more about that.
It's been an absolute pleasure. Thanks, Joe.
Thanks, Archie.